Hello friends, so let us continue revising the chapter portfolio management. Till the previous video we discussed up to CAPM, capital asset pricing model. Now we are moving on to an important area, that is Sharpe single index model. Very important area, and this discussion is going to be a little bit lengthy, but you have to have some patience, and after some point, say after 20 or 30 minutes, you will have absolute clarity. So what are we going to discuss in this Sharpe single index model? First we will try to revisit the calculation of beta. I told you there are three formulas which we studied under CAPM for beta. Okay, totally 6 formulas we are going to learn. The earlier formulas which we learned, okay, regarding the beta was under the correlation method. Now we are going to discuss beta in a different manner under regression model. Okay, regression based model. Now see, so first topic is revisiting the beta. Beta we are going to revisit again, and we are going to calculate beta again under regression model, and we will discuss how both the answers, both the value will be same. Okay, because actually it is derived from regression method only. Okay, it will be same as correlation method, right? Next, we are going to discuss characteristic market line. Next, understanding concept of standard error. Okay, then analyzing a security variance into systematic and unsystematic. I already told that in the CAPM model itself, okay, the Sharpe tries to segregate the risk, total risk, into systematic and unsystematic, and only the risk premium, market risk premium, should be only asked for the systematic risk alone. This we saw in capital asset pricing model itself. Now, how to quantify the risk into systematic and unsystematic, we did not learn that. Are you understanding what I am trying to say? Okay, you told that for systematic risk only you should ask premium. How much premium you should calculate for systematic risk? We calculated using beta into RM minus RF. Okay, RM minus RF is market risk premium. If you multiply it with beta, you get the market risk premium for the systematic risk alone. Are you listening? Now, what here we are going to learn is to quantify the systematic risk and unsystematic risk. Very important. Next, Sharpe index model in the context of portfolio. Okay, there is one more discussion, Sharpe optimum portfolio, which I am not doing under revision model. Okay, revision based lectures, you have it in our regular lectures. I put it. Okay, we used to conduct that in the revision lectures, not necessary. I'll try to put a separate video. It will take a lot of time. Just a formula based application. Okay, there is no substantial discussion available. So what we will do is that we will put a separate video regarding that. No issues. Okay, now moving on to the main discussion. First we will revisit the beta. Now see, we will use this question number 39 and try to understand this Sharpe single index model in a better way. Through numbers we will understand the concept in a better way. Take this question for discussion. Okay, the JK Limited market return, a share price given and dividend per share given. Okay, dividend per share and share price given for JK Limited as well as for market. Now market, how do you find return from the market? I told you. Okay, index will track the return of the market, correct? And then dividend yield will be published. If you see it in the stock exchange and all, they will publish the average dividend yield, okay, from the market. Next, return on government bonds. Okay, for RF they have given this, right? So compute the beta value for year 2002, 2003, 4 and 5 they have given. Compute the beta value of the company at the end of year 2005. Also find out the CML for this and analyze the security variance into systematic and unsystematic. Also find coefficient of determination. What this is we are going to learn, okay, in the upcoming discussion. No issues. This is the question that is being asked. Now, first step. Now they have given 4 years data. They have given 2002, 3, 4 and 5. Correct? Now we need to find out, even though they have given data for 4 years, see, this they have given to find out return, okay, using this formula, P1 minus P0 divided by P0, okay, plus D. Are you all understanding? This we already learned basic computation, okay, in the introduction, first lecture, we have learned that how to compute the return from a security, correct? Which means for that only they have given this. So we will get the return for 2003, 4 and 5. 2002 they have given just for computing, okay, considering the opening balance. See, so first step, what is the first step? Return from the security. See, so year 2002, 3, what is the return I earned? 2002 financial year 2002, 3, what is the return I earned? Very simple, I earned 279 minus 242. This is P1. Okay, price at the end of year 1 minus year beginning price. Okay, the difference is capital gains plus this year dividend, 25 rupees dividend. Are you all understanding? This will be 25.62% return. Like this, I compute return for respective years. 3 years return I got This is return from the share, that is JK Limited. Are you understanding? Yes, JK Limited. Next, return from market portfolio. Okay, just like the individual share, market will also have return, na? Yes, that we need to compute. See, sometimes market return will be straight away given. Sometimes like this, they would have given the data to compute the market return. How to compute? Same way, index at the year 1. Okay, this is I1, na? Index at the year end. Okay, minus index 0, year beginning index. Okay, plus the yield, plus the divided by, okay, index 0 plus yield, because this is yield, na? You can separately just, you can add it. So how much you will get? 1950 minus 1812. If you see here, 1950 is what? Year end index, market index, minus 1812. Okay, divided by 1812 plus 5% dividend yield for the respective year. Okay, are you listening what I am trying to say? Okay, how much is that? 12.62%. Okay, year 2003-4 you get 21.79%, 2004-5 you get 5.32%. Up to this, clarity is there. Shall I proceed to the next discussion? See here what happened. So I can put up a summary like this. See, year 1, 2, 3. This is year 1, 2, 3, 2002, 3, 3, 4 and 4, 5. No issues. I just simply write it 1, 2, 3. Past 3 years data is available. Okay, and I am analyzing the data. Which is, see, for security Y, first year return is 25.62, second year return is 20.07, third year return is 17.05. Like this, I get the return for market as well for the 3 respective years. Okay, now we need to compute beta, na? Here, when you use the correlation based method, okay, I told you there are 3 formulas. Change in security return divided by change in market return. First formula, okay, that only has limited use. You cannot use the formula for all the questions I told you. Then you have, okay, 2 more formulas. Covariance of security and market divided by variance of the market. This we learned. Are you listening? Or, okay, beta, another formula for beta is risk of the security divided by sigma is divided by sigma m into correlation of S and M. This also I told you, one of the formula of beta. Now, we are going to learn 3 more formulas here, step by step. For that formula only, we are going to, okay, prepare a table here. From this table, if you prepare this table, it will be very easy to extract the data from the table and remember the formula. Are you listening? Yes, formula you can by heart, but to solve the formula, you need to understand the table properly, what we have given. See, here is there 1, 2, 3, and then market return is there and security return is there. Now see, you have to be very careful. Here, if you notice, I have put security as Y and market as X. Okay, here X as market and Y as security. Are you understanding? Interchangeably I use, but don't get confused. Here, what really happens, I tell you. If you see the graph, I later revisit the graph and explain. X-axis is there. This is nothing but the return of the market, okay, and this is return of the security. Are you listening what I am trying to say? How much the security return changes, okay, with regards to change in market return, correct? Upper return of the market is the x-axis. Generally, market return x-axis, I put it as x. But sometimes in books, interchangeably they use x, y in the question. Okay, but you have to remember while applying the formula, what should be in numerator, what should be in denominator. Are you understanding? The formula also will have x, y. But that x and y, okay, represent the graphical chords. Are you listening what I am trying to say? Which means if x-axis and y-axis. Are you listening? I'll just elaborate at the appropriate time. No worries. See, what here we are doing is x column is there, then y is there. Here x is market return, y is security return. Assume. Now x minus x bar, y minus y bar. Nothing new. Okay, for computing variance, you do the same thing now. For computing the risk standard deviation, you do the same thing. X minus x bar, then x minus x bar the whole square. Are you listening? Okay, and y minus y square the whole square. All these things we used to do. So what are all the column? You tell me. Here x, y. Okay, which means respective here, security return, market return, x minus x bar, y minus y bar, then x minus x bar into y minus y bar, the product of the deviation, this we already discussed. Then at the end of the discussion, we have x minus x bar the whole square, which is nothing but, okay, x minus x bar I told you na, okay, x is market. Here also I have given same na, yes. So here this is given same, x axis, y axis na, that represents x and y, which means market variance alone I compute in the last step. X minus x bar the whole square. Are you all understanding? Don't ask why there is no y minus y bar the whole square. We don't need it for computing beta under regression for the time being. Are you listening? Okay. Now x minus x bar. Now first we need x bar. Now for that, generally understand regression method generally most probably will applicable to only historical method. The ex post data is there. Na? Only using that data you can calculate regression. Okay. Beta using regression method. Okay, you cannot use regression method generally. Okay, you can do that, but there will be so many things involved. Estimation will not be accurate, and hence, okay, it will not be very suitable for computing regression. Are you listening? So historical data only will be mostly 99% of the time will be considered for computing the beta using regression model. So what we will take first to x bar we will consider. X bar is nothing but, okay, I told you where you are analyzing the past data. How many years data you are analyzing? 3 years data. Apo x bar is nothing but simple average you should consider 3 years return divided by 3, that 3 years total market return, 3 years security return. You will get x bar and y bar. Okay, x bar is 13.24, y bar is 20.91. Are you understanding? Nothing new, already we discussed. After this, okay, x minus x bar you will consider, y minus y bar you will consider, and the product of this and x minus x bar the whole square. Column, all the column are familiar na? Now see, 2 more formulas are there. Now we are going to discuss. This is just an extension that both the formulas are one and same. See, and another regression based equation based formula is there. That from there only these two are actually derived. So one, if you remember properly, that is enough to solve this question. Are you listening? If at all you forgot the entire discussion, don't worry. If you remember one single formula, that is enough to solve the question answer. But here I am trying to elaborate what is this model so that you can understand it in a better way. Okay, see, beta is equal to sigma xy minus n x bar y bar. Okay, summation divided by summation of x square minus n x bar square. This formula alone you remember. Are you all understanding? This alone you remember. This, if you multiply the numerator and denominator with n, you will get the same value. Okay, how? I don't want to get into derivation at all, but believe me, these two formulas, okay, the regular batch we used to discuss here, I don't want to waste your time. Okay, believe me, these two formulas are one and same. These two formulas are one and same, and you remember this one. Okay, you can easily copy the value from the table. You can take the value from table and solve. That is the point. Okay, now you tell me how to remember this summation of x sigma xy. So what is the sigma xy? Very simple. You already have. You don't need to find out anything. You already discussed. Sigma xy is how much? You tell me. Product of x and y na. So where is this? Yes. See. This xy is here. Are you all understanding? Now you have x and y. This already you have 1, 2, 3 for 3 years. You have x value and y value. You just make a product of these x and y. From where you will get here 12.62 into 25.62. You will get the 323.32. Are you all understanding the third column? Okay. First 2 column no issues. Third column also we discussed. Fourth column x square. What do you mean by x square? X square is nothing but market square, market return square. How much is that? 12.62 into 12.62. You are getting the x square for these 3 years. Total of this comes to, this is nothing but summation of x square. What I call this 662.36 summation of x square, and 851.36 is nothing but summation of xy. Summation of xy. Product of these two. Okay, product of the respective return. What is the total? Summation of xy. Are you all understanding? Now simply, okay, substitute the value in the formula and you will get the solution. For example, now see the formula. What is, revisit the formula. Summation of xy. How much is summation of xy? Total 851.36. Here I will write 851.36. Are you all understanding? Just I am showing you how simple is the formula if you use the tabular method. N x bar y square. You tell me n x bar y bar. Now tell me what is the n3, what is the x bar? You already computed, nothing new. If you notice, okay, you already have, what is that? X bar as 13.24, correct? 13.24 into, what is the y bar? Can you tell me what is y bar? Okay, y is 62.74. Okay, y total is 62.74 divided by Okay, see, yes, divided by 3, 20.91. Are you all understanding? If you see the, I have put it summary, you can easily go through. X bar is there, Y bar is there, summation of X is there, okay, summation of Y is there, sigma X square, sigma XY. So, now Y bar we need now 20.91, okay, into 20.91. Just to substitute, divided by summation of X square we have this column here in the last, total of it 662.36. So 662.36 minus n is nothing but 3 into x bar square. X bar is 13.24 square. If you solve this, you will get beta as 0.15. Are you all understanding? Okay, I have solved this here and I have shown the computation also. You will get 0.15. This is not the issue. Just a computation of beta, how we compute beta. Okay, under the regression model, I just shown you computation. You will understand the logic, everything regarding Sharpe single index from now on. Are you all listening? First step, how to compute beta under regression based model if the data is given. Is this clear? Shall I proceed? Okay, now this 0.15, if you remember, under correlation method also you will get the same. Are you all listening? Under correlation method also, you will get the same answer as 0.15. Understanding? Only thing is, if you apply this very same question can also be solved under correlation method, no issues. Why? Because you can find the covariance, you have all these data, you can find covariance, correct? And you can sigma m, obviously you can find out sigma m square. Okay, if you divide the covariance of S and M divided by sigma m square, you will obviously get the beta value. Under correlation method, no issues, correct? The answer will be same as 0.15. I am just showing you how to compute under regression model using this formula. Are you listening? Is this clear? These two formulas are clear. Again, this if you multiply with a numerator and denominator with n, I told you will get the same answer. I also showed you computation. That is not an issue. Now, come to the main discussion. One more, angle I told you, this actually these two formulas came from the regression equation, correct? Regression equation, from there only you got these two formulas. If you know these two regression equation, okay, you will get alpha value as well as beta value. You can solve the alpha value as well as beta value. What this regression equation is all about, we will try to understand the characteristic market line, okay, regressed line, then we will try to analyze the last portion alone. This I am keeping it as a pending thing. Okay, once I discuss the example, from there you will understand the regression method. Shall we? Okay. Now focus on the main issue. What is the characteristic market line we are going to discuss? See, very simple. Now we have this graphical representation I told you, x-axis and y-axis, correct? X-axis represents, okay, the influencing variable, which means whichever is the influencer, okay, that will be represented as represented in x-axis, which means you have to calculate the influence of one variable, okay, to the other variable, which means x-axis is nothing but return of the market, which means if my market return changes by 1%, what is the impact in the security return? Okay, if you want to analyze, then if you want to plot it in this graph, you have to put it market return in x-axis and security return, okay, which is getting influenced, which may be very simple. What is influencing and what is getting influenced, you need to analyze. Are you listening? If I am pushing you, who is the influencer? I am the influencer. You are getting influenced. Are you understanding? Same way, if security market return is the influencer, which means market return if changes, that only brings volatility in security return. Yeah, if you change the market return, if Nifty is falling, the shares are also falling, which means the influencer is Nifty, okay, the index, and the influenced person is influenced thing is what? Security return or security, simply security. Are you listening? So x-axis represents influencing variable, y-axis represents influenced variable. In this case, the market portfolio influences the securities return. Hence, RM or return of the market is called put as x-axis, okay, variable, and RI means return of the individual security. RI means return of the individual security, okay, is called as return on investment or security. Okay, it's not return on investment or security, return on individual security is called as y-axis, okay, is represented as y-axis. See, now I will give you an example and then I will come back to this. Okay, little bit elaborate discussion is required, then only you will have absolute clarity. Please bear me 10-15 minutes, then you will have absolute clarity. See, now Assume I have given a data. Forget about this question. I'll come back to the question later. Why this question is different, how we cannot apply this in this question, I'll tell you later. See, take an example here. Suppose year 1, 2, 3, 3 years return is given. Market is giving a return of 1%, 3% and 2%. Are you listening? First year, the market is giving a return of 1%. Second year, the market is giving a return of 3%. Third year, the market is giving a return of 2%. Are you listening? Now what happens? This is the influencing factor. Now what happens to the influenced factor? What happens to the security? If market is giving this much percentage, see, assume, if market is giving me 1% return, security is giving me 4% return. If market is giving me 3% return, security is giving me 8% return, and market is giving me 2% return, now security return becomes 6%. Are you all understanding these three variables? Now, if I plot the same in the graph, I'll try to plot the same in the graph and I'll try to analyze what is happening inside it. Okay, see what happens. See, there is no ambiguity. This is exactly ditto plotted. This is not representation picture, this is actual data taken. See, market return, I assume first case, and what is the first case? Market return 1%, this is 1. Okay, if you carefully observe this 1%, this is 4%. Are you all understanding? Which means if market increases, market gives a return of 1%, the stock gives a return of 4%, agreed or not? Are you all listening? Next, okay, market gives me a return of 3%, which means the market gives a return of 3%. In this case, what happens if you notice? Okay, the security is giving me 8%. The security is giving me 8%. If you see the x-axis, it is touching 8%. Are you listening? Now, next, when market gives you 2%, it is giving 6%. If I plot this x and y data into the graph, what happens? It forms a line. It is a linear equation, and hence it is forming a line. Are you all understanding this? Okay, now, very important observation. Okay. In the above graph, we could see that the plotted points automatically fit into a straight line sloping upwards. This indicates that correlation between the security return and market return is perfectly positive. First observation is that it falls in the straight line. Since it falls in a straight line, I already told you in the Markowitz portfolio theory, okay, when correlation is perfectly positive or perfectly negative. Perfectly negative means downward slope. Perfectly positive means it will go up. Are you all understanding? If it is perfectly positive, it will form a straight line and not the curve. Okay, only when the correlation is not perfect positive, then only the curve will form. That is why efficiency frontier came into picture under Markowitz portfolio theory. Are you all understanding? Now, how is perfectly positive correlation happening? Very simple. You see here, what is the thing now? Very simple. For a given line, this is line now. For a given line, how to find out the slope? There will be two things. One is the slope and another is the intercept. Are you all understanding? For a given line, okay, you will have intercept as well as slope. Correct? The mx plus c which you use now, the equation for straight line. Okay, that only is applicable. Here, if you see the beta formula, first we understood one formula na? Change in security return divided by change in market return. You will get same beta. The beta answer will be same as whatever you solved using regression method, I told you. So, change in security return divided by change in market return, typographical error, no issue. See, if you see 8 minus 6, okay, divided by 3 minus 2. For a 3% return, the security will give you 8% return. Are you understanding? Okay, minus 6 na, for a 2% return, security will give you, okay, 6% return, which means the change in security return is 2, change in market return is 1. Which means for 1%, it is giving 2 times the return of the market. Security is changing 2 times the return of the market, which means market gives 2% return, security changes by 4%. Like this, you need to analyze. Are you all understanding this first? Okay. The above formula for beta can be used only when correlation is perfect. This formula I told you, this is nothing but formula number 1. Correct? This formula number 1 can be only used when correlation is perfect positive. Can you use this formula when correlation is not perfect positive or perfect negative? Correlation is perfect means it should be either -1 or exactly +1. If it is something in between, you cannot use this formula. It will be scattered. Yeah, it will be scattered. It will be like curve and not a straight line. Are you listening what I'm trying to say? Okay. Now the problem is, okay, the question number 39. Come to question number 39. This you understood regarding the basic thing. Okay, now come to the question number 39. We have security return, we have market return. Can you apply the change in market return divided by change in security return? No. Why? Correlation is the beta is 0.15. Other correlation is not perfect. Okay, hence you cannot, it is not coming straight line. You plot this in graph, you just plot this in graph, and whether you are getting straight line, you will never get. What happens, you see, I plot this graph 25.62 and 12.62. Year 1, I have 25.62 as return. Are you listening? This is Y, which means security is return. Okay, 25.62. Are you all understanding? If I plot, I'll get somewhere around here, and this is nothing but, if you see carefully, okay, it is coming between 10 and 12. What is the number? 12.62. Yes, 12.62. Assume this is 12.62. Are you all listening? Like this, if I plot, this is one number, 20.07. This is first year. This is first year return, actual return of market and return of the security. I'm just plotting whether it is forming a straight line. I'm trying to figure it out. Okay, this is second one, 20.07 and 17.05. If you observe, this is never forming a line. Are you all understanding what I'm trying to say? This is never forming a line. Why is not forming a line? Very simple. The correlation is not perfect. Hence it will never be line. That is not my issue. Okay, if you see, since it is not linear line, what we are trying to find out under regression model, okay, I am trying to find out a line of best fit. I am trying to find out line of best fit, okay, which is regressed line, which means average line. Now see, I can draw a line in between these three numbers which can form a mean line. Are you listening what I am trying to say? If you take a class, okay, in this class, assume what is the average weight is 70 kg. I get the weight as 70 kg. Some numbers will be scattered, someone will be 80 kg, someone will be 60 kg. What is the average? Like this, okay, if I have this return on risk of the return of the market as well as the security, and I try to plot this, I'm not getting a straight line. I want to draw a representative line, average representative line. This is called as line of best fit, or line of regressed line, okay, or average line. All this we can use for regression. This line is, see here, can you carefully observe? I can show you here. Can you see this? Okay, this line is there, this is the line of best fit, regressed line. Okay, this is nothing but characteristic market line, which we are going to learn anyway. This is what they call it as characteristic market line, which is representative of the the slope and the intercept, and this is not the real line. Are you understanding? This is not the real, the line which you get from plotting these numbers, which is a representative line. Understood? Okay, now it can be seen that everything I have given notes. If you undersee, what I will do is that I will discuss all these things. If you are clear with the concept, well and fine, I will move on. If you are not clear and if you are getting confused, you may listen to it once more. Even then, if it is confusing, just leave it. At the end of the discussion, I'll tell you what are all the things to remember for the examination. That alone you by heart and go, that is enough. But I am trying to elaborate these things so that some questions, okay, you should not get later on whether I should take this number or that number. Okay, that is why I am discussing all these things here. Okay, it can be seen that the points in the graph are scattered, which indicates that the correlation is imperfect. First observation, since the point is scattered, the correlation is imperfect. In such a scenario, we cannot calculate the slope or beta using this formula. We cannot calculate using this formula. Are you listening? Now, because the slope between any two points is not same, obviously it will not same, it is not linear equation. Now, we have to discover a representative line that establishes this relation, and this we used, okay, this is called as line of best fit, and this is solved using regression analysis, okay, equation. We have two regression equation. If you solve this, you will get alpha value, beta value. What is this alpha value? Very simple. What is, you tell me, what is the equation for line? Equation for straight line is nothing but mx plus c. You would have studied, okay, this is nothing but, okay, 12th, 11th, 12th basic mathematics, mx plus c, wherein c is a constant and this is variable. Are you all understanding? This is variable, which means this is slope, this is a constant, and this is the slope, which means you will get the intercept as well as the slope value. Listening, so which means here I can yes, in this context, I'll tell you what it is. Ri bar is equal to alpha plus beta into Rm bar. This we already solved one question under CAP. I told you there, I will discuss it here. Yeah. Okay, I told you the characteristic market line. While discussing characteristic market line, I will discuss. Here I am discussing. See, what is this? Mean return of the individual security is nothing but, okay, alpha is what? Intercept. Very simple. If I show, 1 second, what is alpha? Very simple. This line is there. You can plot this, you will get the line. But this actually is not like x-axis, y-axis. This is actually a quadrant. You should visualize it like a quadrant. This is really a quadrant. Are you listening? Now, if you get a line of best fit like this, this is again line of best fit, okay? Like this, what you should do, you should extend it and find, it will go like this now. If you keep on extending, it will go like this. You will have the intercept value here. Are you understanding at what point it is intercepting the y-axis? This is the intercept point, okay? So here, this is the line of best fit, correct? See, for example, in this equation, this equation we have line now. If you extend the line, you will get this point as intercept. You will get the point as intercept, the point where this line touches the y-axis. Are you listening? Which means here also we have the line of intercept. Okay, this is called as alpha. The alpha is nothing but intercept, and we have to have the slope. Now the slope is represented by the beta. Okay, how to find alpha and beta? Very simple. We have two regression formula. Okay, we have to find out. Very simple. Summation of y is equal to n alpha plus beta into sigma x. Equation 2 is sigma xy is equal to alpha, okay, sigma x plus beta x square, beta summation of x square. These two regression formula, if you solve, okay, you will get the regression equation as such. This is Ra bar is equal to 18.93 plus 0.5 Rm plus Ei. Now, how do I get 18.93 and 0.15 Rm? Don't ask me, because now I'll get back to the main discussion. See, I have put it the calculation here. This equation only I have put it here. Are you listening? These are the two regression equation. From here only you got that formula. Remember? Okay, those two formulas derived from regression equation. Now, if you solve these two, you will get the alpha value as well as the beta value. See here, very simple. If you substitute simply, summation of y is how much? 62.74 is equal to n alpha, 3 into alpha plus 39.73 beta. Okay, summation of xy is 851.36 is equal to 39.73 alpha plus 662.36 beta. Simultaneous equation method. If you subtract, okay, first equation from the second equation, okay, you will get the value alpha and as well as for beta. Okay, you can go through, there's nothing to discuss. You got the alpha and beta value now. Now, you tell me children, what is this alpha and beta value? This is intercept. Alpha is nothing but intercept value for the regressed line. Whether this will be actually line, no, it will not be line. It is a representative line only. But for that representative line, there should be one intercept. This is alpha, which means for this, if we get 18.93 is nothing but intercept for the regressed line. 18.93 plus 0.5 Rm plus Ei. This is return of individual security. If I use, okay, Ri bar, you will get, okay, there will be no error term. I'll discuss about the error term later. First understand what is this regressed equation. See, the regressed equation, I told you it is a line of best fit average line. If you want to find out average line, it is nothing but Ri bar return, okay, mean return of the individual security. What is Ri? Individual security. Mean return of the individual security is equal to alpha plus beta times the return of the market. Are you all understanding? Here also, Rm is nothing but Rm bar. The mean return of the market you should consider and not the actual return of the market. Are you all understanding? Now 3 years data you have, correct? You find out the return of the individual security. You need to find out the mean return of the individual security, okay, wherein you have the alpha and beta times the Rm. Are you listening? So which means return of the individual security as per the characteristic market line is nothing but alpha plus beta times the Rm bar. Now, the security return is 0.15 times the market return plus 18.93. Are you all listening? What is the understanding from this? Security return 18.93 is just like, okay, in CAPM you had something like RF point. RF point was there in the y-axis, correct? Which means RF plus beta into RM minus RF. Are you all understanding? In CAPM, I'll just show you here what happens under CAPM. In CAPM, what happens? Okay, you have RF plus beta times the RM minus RF. This RM minus RF is market risk premium. This premium, if you multiply with beta, you will get the systematic risk portion. Apart from that, you have RF. If you add this with RF, you will get the KE. Are you understanding? This is nothing but KE. Upper KE is nothing but RF plus market risk premium. Agreed? Now this instead of RS in the Sharpe single index model, we use alpha, which is nothing but intercept. There also, if you notice, I told you this is the RF and this is RM, means RM minus RF. Are you listening? This portion, and this is plus RF. This total will be the required rate of return I discussed in the graph. Are you listening? Same way here also. This intercept will be alpha. It is called as alpha. Agreed? The RF, instead of RF, we use alpha, the intercept. Are you understanding? Okay. See. Now this is fine. So to compute return of the individual security, it is nothing but alpha plus beta times the RM plus beta times the RM, which gives me, okay, the required rate of return for the security, individual security. Now all this is fine. So what is this EI? Okay, what is this error term we are going to discuss? See, concept of standard error. So what do you mean by standard error? See, very simple. The difference between actual return and regressed return is called as standard error. Very simple. Okay, I told you that the actual security return, if you plot in the graph, it may not be, okay, in the falling in the straight line, which means it will be scattered. Yes, and the regressed return is line of best fit. Agreed? If you plot that, it will fall in the same line. Are you understanding? Straight line. The difference between this is called as error term or standard error. Very simply, okay, very simple. I'll try to explain what do you mean by the regressed return first. How to compute regressed return? We use this regressed return using the formula. Very simple. Return of the security bar, which means, okay, regressed return, I use this bar, okay, average return is equal to alpha plus beta into RM. 18.93 we found out the alpha there. Beta 0.15 also we found out. Just replace with respective years return of the market, you will get the regressed return. I will show you how it is being calculated. First we will compute regressed return for 3 years for this security. Shall we? Very simple. See, year 1, RM is what? 12.62. Okay, the RM is 12.62. Now regressed return comes to how much? Alpha is 18.93 into beta times the 12.62, which means take your calculator. 18.93 plus 0.15 into 12.62. How much is that? Okay, 18.93, 20.82, 3 rounded off, 20.82. Are you understanding? Like this, next year return of the market. So, which means the market return varies now. Accordingly, the regress return will also varies using this equation. So, year 2 you have regress return of 22.2, year 3 you have regress return of 19.7. Are you all understanding? You tell me, children. These numbers, the 20.82, the 22.2 and 19.73 will fall in the same straight line or will not fall in straight line. It will fall. Are you all understanding? That is what I have plotted here. If you see, okay, I have given in the notes. Okay, see what happens here. Okay, here if you notice, this is the regressed line. I am just rubbing it off. Okay, can you see this? Okay, now see. The point I have given here, if you see, this is the actual return, correct? Now, if you plot this, you will get this line of best fit now. You will get the regress return. Okay, I'll just show you. You take one number, I'll just show you. RM is 12.62. Okay, regress return 20.82. Regress return 20.82 of the security. If you notice, this is 20.82. Okay, where is 20.82? You will get somewhere around here, 20.82. Agree? but it depends on market now. See here what happens. RM is 12.62. RM is 12.62, and this 12.62, if you see this is 23. The actual return is 25.62. Are you all understanding? For 12.62 RM, the actual return is 25.62. But if you see here, if you see the regressed return of the security, it will fall in the same straight line. At this point, it will be there 20.82. Are you all understanding? It is not going till 25.62. If you notice, it is only 20.82. Okay. This is regressed return. Now, second year also, if you see, for RM of 21.79, what is the regressed return? 22.2. 21.79 is the RM. Okay, 21.79. It will come somewhere around here. Assume 21.79. This is the return of the market now. If you see, okay, this line will have its own regressed return of the security will fall in this line. Okay, what is the amount? What is the return? Yes, 22.2. Like this, it should come, see, in the line of best fit. Even though the corresponding return is something different, 20.07, the line of best fit, the return, okay, will be 22.2, which falls in line of best fit. Are you all understanding? Which means the standard error is nothing but a deviation from the actual return. Are you all understanding? Actual return, if you plot the actual return, it will not be in the line, but the corresponding return which falls in the line is called as regressed return. Are you listening? Okay. Now, what is the use of, you have explained a regressed return. What is the use of this regressed return? Very simple. Okay, I am using this regressed return to explain the standard error. The difference between regressed return and actual return is called as standard error. Very simple. See, the regressed point will lie in the line of best fit if the correlation is, this is if, okay, if the correlation is perfect, the actual return will also lie in the line of best fit. But when correlation is not perfect, the actual points will be scattered. I just explained, okay, above and below the line of best fit. The difference between the regressed point, this is very, very important. The difference between the regressed point and actual point is called as standard error. Now, I will show you the computation also. Very simple. If you see, for year 1, actual return of the security comes to 25.62, regressed return is 20.82. okay, actual return falls above the line of best fit. Okay, the difference, okay, you tell me what is the standard error? Positive? Yes, because actual return of the security is more than the regressed return. So error is in terms of positive, which is the actual return is over satisfying the okay average return, correct? Next, 20.07 is the actual return, but the regressed return is 22.2, which means the actual return falls below the line of best fit. Hence, the error is minus 2.13, negative side error. And next, third year, if you see, 17.05 is the actual return, and regressed return comes to 19.73. Okay, again, regressed return is 19.73, and actual return is only 17.05. Hence, there is a negative error. Okay, error in the negative side. How much is that? 2.67. Now, important observation. The total of this error term will always come to 0. Are you all understanding? Then only this is called as line of best fit. Yeah, are you all listening? Which means if the total is not tallying, then there is no point of calling this as line of best fit. Are you all listening? It will, okay, it will be a representative line which, okay, removes the exaggerated values, which removes the extreme values, and we get the total as 0. Are you all understanding the computation now? Only when the error total is 0, the line can be called as average line or line of best fit. Now, I told you 2 equations are there. One is the return of the individual security. This is actual return. Okay, I'll just show you here. Very simple. See, there is 2 returns here. One is actual return of the security. Return of security. Then there is regressed return of security. Regressed return, or this is average return of the security. Are you all listening what I am trying to say? Okay, the return of the security which falls in the line of best fit, I call it as regressed return, and the actual return is what really the security is giving, actually giving. Now what is happening? I am forming an equation, RI, return of the actual security, is equal to Okay, this formula, what is the formula for actual return? Ri, I'll call it as Ri is equal to alpha plus beta into Rm plus EI. Error term I will include. Are you all understanding? This becomes plus or minus. Why? Because if it is positive, you will add. If it is negative, you will reduce. Error term can be positive as well as negative. Both the illustration I have given. Right? So this is the actual return formula. When it comes to regress return, what happens? Very simple. Regress return means it's already averaged out. Will there be any error term? No, you can see, very simple. Regress return, there will be no error term. No error term, because you have already discounted for error. Yeah, you are listening what I am trying to say, understanding, which means, see, you cannot predict the error. What is that? You can, okay, have error in your prediction, but you cannot predict the error. Are you understanding? Which means, okay, here there will be no error term. Then return Ri, this I call it as already regress return. Ri bar is nothing but, okay, alpha plus beta times the Rm bar. Are you all understanding? Here, if you use the average market, then you will get, and there will be no error term. Plus or minus error term will vanish, because this will have never any error term. Are you listening? Okay, this is the two important thing you need to understand. This is what I am consolidating here. Are you listening? Which means actual return of the individual securities when you compute. To summarize, actual return of the individual securities when you compute, you will have error term because there will be deviation from the regressed return. Correct? When you compute regressed return, there should not be any deviation. The error term vanishes, and the formula becomes, the equation becomes alpha plus beta times the Rm bar. This Rm bar is nothing but, okay, average market return. Are you understanding? Here this is respective return for the respective years. Okay, respective years return. Nothing else. Okay, see here. Now you will understand. Checking actual Ri using the equation this. Okay, apo. The Ri we already computed here. Now using this Ri, if we plus or minus this Ri, this should give the regressive return. See, regressive return we computed like this. Agreed? See, Rm 12.63 respective years regressed return we computed. Agreed? Now respective years regressive return we already computed. Now if we compute the using regression, adjusting the error term, okay, are we getting the regressed return? This is what we are checking. So which means return of the security is 18.93 plus 0.15 Rm plus or minus the error term. Here 0.4 plus 4.48 plus 4.8, I add this 4.8, we get 25.62. Next year 18.93 plus 0.15 into 21.79 minus 2.173 on the negative side, so we will get 20.17 and 17.05. These three numbers are nothing but your regress return which you computed here. Are you the actual return which you computed here? Are you understanding? Okay, which means regressed return plus or minus this error term, whatever it is, we computed using this equation. This is nothing but actual return. This is nothing but actual return. Why? Okay, this is not Ri bar. Regress return will be denoted by Ri bar. This is actual return. Are you understanding? Now, the main discussion starts now. Sir, you told that in the Sharpe single index model, we are going to segregate total risk into systematic as well as unsystematic. How the segregation happens, you listen to me. Okay, see, the character, first we need to break down the the equation first, then each and every characters we will understand, then we will proceed to the division of systematic and unsystematic. See, if I were to explain just the formula, if I just make you understand the formula now, I can simply say that you by heart the formula and go for examination. We are trying to understand what is the concept behind this, so this will take little bit time, but once we are through, I will summarize this fully and then tell you whatever you should retain, what you should retain or remember at the end. Are you listening? See, the characteristic market line is what? This is the characteristic market line. Return of the actual return, this is nothing but actual return, okay, of the security is alpha plus beta into Rm plus EI, plus or minus EI. This is what the equation is. In this equation, there are 5 terms here. One is that, okay, alpha and beta, this alpha is there and the beta is there. Agreed? And there are variables, return of the security, return of the market, and EI. Are you all understanding? 5 terms are there. Alpha and beta are constants, For one security, if you find out the beta, it will remain same for the computation purpose. Are you all understanding? Yes, beta of course will keep on changing after a year on. Okay, year by year it will keep on changing, but that is not an issue. Generally, for computation, purpose, assume this year you are computing various things and the beta you should take. This beta will be same for one security. Are you understanding? One security will not have many betas. So, alpha is there and there is a beta. Alpha is also constant, beta will also be constant. Now, there are 3 variables. One, RA is nothing but return of the individual security. RM is the return of the market for respective year. And there is a error term which will also keep on varying. Are you listening what I am trying to say? Okay, now. For constant, the actual and the mean are the same. Why? That's why they are constant. You tell me why the name constant comes, because there will be no variability. Okay, there will be no variation from the mean. The constant will remain same. Hence, okay, beta alpha bar, alpha is equal to alpha bar, beta is equal to beta bar. Both are one and same. There is no issue there. Correct? Now, when it comes to variable, you need to understand 3 variables are there. So, you have RI and RI bar. You have RM and RM bar. And you have EI and EI bar. Like this 3 variables are there. Correct? Here also if you notice, RI bar, RM bar and EI bar, expected return of the security, expected return of the market portfolio. What is RI bar? Expected return of the security, mean return of the security. RM bar is expected return of the market and EI bar is expected error. Are you all understanding? Here the EI bar, you tell me whether expected, there is something called as expected error? No. We cannot expect error. Are you listening what I am trying to say? Your expectation might have some error, which means while predicting there might be some error, but error should not be expected. As such, when you are predicting, you should not predict the error. Listen here. Shit. When we predict using regression, our expected error should be 0 because we cannot predict error. There can be only error in prediction and we cannot predict the error. Thus we have 2 CML equations. Here we have 2 CML equations. One is based on expected return, which is RI bar is equal to alpha plus beta into RM bar. Are you listening? This is one equation. Actual return equation is RI is equal to alpha plus beta into RM plus EI. Very simple. If you want to find out the actual return, there will be some deviation. EI will be coming into the picture. When you want to find the regressed return of the security, then EI vanishes. And simply the market return, mean return of the market will replace. RI bar is equal to alpha plus beta into RM bar. Are you all understanding? Now let us calculate variance of the security return, market return and error term, and finally I will conclude how to find variance of the variance of the systematic risk, which means systematic risk is there how to segregate the systematic from unsystematic. Are you all understanding? See, last step, please observe what happens. Now we are computing what? Variance of the security return, variance of the market return. Variance means what? See, in the Sharpe model, they are trying to find out the risk in terms of variance, not in terms of standard deviation. In CAPM, CML, Markowitz, all other standards use, other portfolio theories used standard deviation as measure of risk. Here, we are using variance as a measure of risk in Sharpe single index model. That is very important. Now, variance of security return, you don't need to square root. That's the only thing. Now, same computation, variance of security. So what we need to find out? Variance of security return, variance of market return, and then variance of the error term. All these 3 we will try to find out. So variance of security return, how to find out? Here 1, 2, 3 is there. RI respective years actual return of the security. These are all RI means actual return of security is there. Total of this divided by 3, simple average, you will get mean return, or put it simply, this is what? This is nothing but RI bar. Are you all understanding? We got RI bar. Now, next step, Y minus Y bar. This is nothing but, see, what is Y minus Y bar? Actually, it should have been this. I put security return as Y. Why? Because in the graph, it is it represents y axis, na? That's why I put it as y. Don't get confused. The security might be x. If the security name is x, it is x minus x bar only. I have put it y, okay, to always insist the point that it comes under influenced thing. Okay, it is a variable, influenced variable and not influencing variable. Okay, influenced variable comes in y axis. Are you listening? So y minus y bar, now simply put 25.62, right? Now 25.62 minus 20.91 positive 4.71. Sign is important. Next, y 20.07 minus 20.91 minus 0.84, 17.04 minus 20.91 minus 3.86. This is x minus x bar. This is the deviation. Next step, square root the deviation, square the deviation, x minus x bar the whole square, y minus y bar the whole square, which is 22.18, 0.71, 14.9. Now this is, you are using historical data, past exposed data. First lecture itself I told you how to find a standard deviation. Okay, we are not finding standard deviation. How to find variance? Very simple. Okay, the summation of y minus y bar, in this case summation of y minus y bar the whole square, okay, divided by 3, which means the summation of y minus y bar the whole square is how much? 37.79 divided by n. If you do, simply you will get 12.6. This is the variance. This is the variance. If I square root it, I'll get standard deviation, but Sharpe single index model uses variance as measure of risk. Hence this is the way to proceed. Are you all understanding this? Next, variance of the market portfolio return. Next, what we are finding? Okay, variance of market portfolio return, which means standard deviation of the sigma m square we are finding. In that case, sigma security square we found out, which is variance. Here sigma m square we are trying to find out. Same drill here, 1 2 3 and x. This is the x. You should not get confused. Again, x represents the x axis. Okay, which means market, which means RM. That's why I put it in bracket RM. Okay, there individual security, here RM, market. So market return, actual return 12.62, 21.79 and 5.32. We got 3 market return, yes. Now x bar, how to find out? 12.62 plus 21.79 plus 5.32 divided by 3, you will get 13.24 as RM bar. This is nothing but RM bar. Are you listening? Now x minus x bar the whole square, you need x minus x bar. Respective years you do 0.62, okay, 8.55 and minus 7. Again square it up, x minus x bar the whole square you will get, and add a total, you will get 136.21 divided by 3, you will get variance of the market. Okay, sigma m square, this is what? 41.4 is nothing but variance of the market. Listening? Now we got 2 variances, variance of the individual security, variance of the market. Now come to the third thing, which is standard error. Variance of standard error we need to find out. Very simple. What happens, you tell me? Okay, EI respective years error term I put it. Okay, just like you compute the standard deviation, okay, error will also have deviation. Of course, yes. So what we need to find out is that we will find out the variation of the error term. Are you understanding? Which means very simple. What is the mean of this error term? Don't ask me this silly question. Mean of the error term will be 0. Are you understanding? I told you, mean, if you total it out, okay, it will come to 0. Anything divided by, if you, okay, 0 divided by 3 is what? Are you listening? What I'm trying? Any number if you divide it by, 0 if you divide it by any number, you will get the 0 only, right? So which means mean is there, EI bar, you will get a 0 only. Okay, are you listening? Now, EI minus EI bar, simply 4.8 minus 0, you will get the same number as EI. This column is nothing but EI. Listening? Now, EI minus EI bar square, simply you square it up, 4.8 square, 2.13 square, minus 2.67 square. If you total it, divided by 3, you will get variance as 11.58. 11.58, this is nothing but, okay, variance of EI. Okay, how much is that? 11.58. Are you all understanding till now? Understanding, Now the important discussion, the conclusion. Sir, all this discussion you made, you simply tell me what is the risk, okay, variance as per the Sharpe model. I told you in the entire portfolio management chapter, what we are concerned with, only 2 things: risk of the security, return of the security. Okay, risk of the portfolio, return of the portfolio. This is what we are concerned, correct? Now, all this discussion you made, tell me what Sharpe says with regards to risk of the security. Okay, very simple. What he says, see, variance of the security, risk is measured in terms of variance. Unlike other models, this in terms of variance. No issue. Variance of the security or risk of the security is simply beta square sigma m square plus sigma EI square. Are you listening? Beta square sigma m square plus sigma EI square. Now you tell me, what is this beta square m square, sir? Okay, beta of the security square. Okay, this is the beta of the security. Now, what is this beta square m square, sigma m square? Very simple. This represents systematic risk. This represents systematic risk. Sir, how to quantify the systematic risk? Sir, variance, I got it. This is the total variance of the security. Out of this total variance, how much is the systematic, how much is the unsystematic? To put it simply, I'll just show you. Here if you notice, okay, we got the variance of the security, how much per 12.6. Are you listening what I'm trying to say? The variance of the security, we got it as 12.6. Agreed or not? We already computed, correct? In the step 1. Now, this 12.6, okay, we should now divide it into systematic as well as unsystematic. Listening? Now, what is the sigma m? You tell me, what is sigma m square? If you notice, what is sigma m? In this question, sigma m, okay, we computed na? Yes, sigma m square is variance of the market. How much is that? 45.4. See, sigma you don't need to compute here. Sigma m square is variance na? Variance of the market return. How much is that? 45.4. So we computed already 45.4. Agreed? If you multiply this with beta square, you will get unsystematic risk. I'll just show you what will happen. You tell me. You see, here we have 12.60. Very, very important. Forget about all the other discussion which I made. If you are good enough to understand this is enough for your examination or any other purpose. Okay. See here. I'm summarizing here. 12.6 is there. This 12.6 is what? Please tell me, children. Return of the risk of the security. Do not return. Risk of the security. Okay, this is the risk of the security in terms of variance. Okay, variance sigma square. This is okay as per Sharpe. Now, this we need to quantify and divide it into systematic and unsystematic. Agreed? Now, the problem here is when you are dividing it into systematic and unsystematic, you tell me, I told you what is the formula to be used for systematic. There is nothing but beta square sigma m square. This unsystematic sigma EI square. If you total this should tally, this total should tally this risk of the individual security, which is 12.6. Are you all understanding? Now shall we compute and show? Okay, beta is what? 0.15. We already computed, correct? Into 0.15. This is beta square. Into sigma m square, we just now computed into 45 point some number. What was the number? 45.4. Okay, 45.4. Please tell me what is the number? 0.15 into is equal to into 45.4. How much is that? 1.0215. Some number rounding of 1.02. Assume. Okay. Plus sigma EI square. Okay. Just now we computed the variance. This is nothing but variance of the error term. What was the variance of the error term? Okay. 11.58. Are you all understanding, my dear friends? Okay. 11.58. So, if we total this, you will get 12.6. 11 plus 11.58. Some rounding off will be there. Yes, 12.6015. Okay, no issue. You will get this 12.60, which is the total risk. Are you all understanding? So, as per Sharpe single index model, what is the risk of the security? Variance of the security in terms of variance. Variance of the security is beta square sigma m square plus EI square. I explained all the terminologies associated with this. Are we clear? Are you all understanding what we did? Okay, we found out the risk of the individual security, risk of the individual security, risk of the market, okay, RI bar, RM bar and EI bar. How EI bar is nothing but 0, okay, expected return of error will be always 0, mean return will be 0, deviation will be captured through EI square. Are you listening? Everything I have explained. Now, the security return varies. Now, the real explanation, if you want, you can go through. The security return varies. Why? Because the market portfolio return varies. How much the security return varies? It varies beta times the market return. That's why we multiplied beta into RM. Correct? Since we are measuring risk as in variance term, this is nothing but beta sigma m square, beta sigma m square. This is systematic risk. This is what is systematic risk. Out of the total risk, whatever is correlated to the market, okay, will be measured like this. The variance of the security return due to the variance of market return is just 1.02, which means out of this total return of 12.6 of this security, assume there is a Reliance Limited. Okay, the Reliance Limited risk is how much? 12.6. Out of this total risk, the systematic risk just comes to 1.02. What is the reason for the balance 11.58? Okay, this is unsystematic due to company specific reason. It is the unexplained, okay, cannot be explained due to systematic changes, which cannot be explained due to systematic changes. There is some other company specific factors which you should not ask premium for. Are you understanding? This risk is called unsystematic risk. That portion of the risk, okay, now we got systematic, unsystematic, you understood now? How to segregate systematic, unsystematic, how to quantify in terms of formula also I explained. Now the important thing, one more terminology, okay, you need to understand. Coefficient of determination. There is something called as coefficient of determination. Now very simple. The 12.6 we divided into two things. One 1.02, other is 11.58. This 1.02 is due to market reasons. Hence this is determinable risk. This I call it as determinable risk. Okay. This is determinable risk and this is undeterminable risk. Are you listening? Now, what do you mean by coefficient of determination? Coefficient of determination. COD na coefficient of determination is nothing but, okay, the systematic risk by total risk, which means that portion of the risk which is determinable due to the market reasons, or which I call it as systematic risk, which is beta square sigma m square. This I call it as coefficient of determination, and this, okay, is the balance portion out of this risk. Okay, this is coefficient of determination. You will get in percentage terms out of 100. Say, okay, this is nothing but, you tell me what is the systematic risk? 1.0215 divided by total risk 12.6. Please tell me, divided by 12.6, how much it is? Okay, sorry, 1.02 divided by total risk is how much? Yes, 8%, sorry, 0.08, which is nothing but 8%. Okay, the balance is 92%, which means very simple. Coefficient of determination captures the ratio, proportion of the risk, okay, due to market reasons, which means that portion of the risk which is determinable due to market factor is called as coefficient of determination. So in this example, out of the 12.6 risk, okay, only 8% of the risk is due to market factors and balance 92% is because of the company specific factors. Are you understanding now? Clarity irka? Now see here, I have given you this. See, that portion of the risk for which the reason can be determined, okay, or due to the market is called as coefficient of determination. It is calculated as follows. COD is systematic risk by total risk, and then in the sum, COD is 0.08, which means 8% of the security risk is due to the market risk, and the balance 92% is company specific, okay, which is not determinable and unsystematic as well. Are you listening? With this, we are through with the concept called as Sharpe single index model. And one more thing is there. Now we have computed risk and return. How to compute return and risk of, see, one more thing. I'll just summarize here what we learned. I told you now, I'll summarize. See, very simple. Okay, here. Carefully observe what you are doing. See, return of the individual security we found out. How we found out? See, return of the individual security or yes, return of the individual security is nothing but, see, this is actual return. How to find it? Alpha plus beta into Rm, okay, plus EI. Like this, we'll get the equation for actual return of the individual security. Is this clear? This actual return. I'll just put it, whatever we discussed, we summarize and then move on. Next is Ri bar. This is Ri bar, which I call it as even required rate of return, which is interchangeably used as expected rate of return. Required rate of return as per, or this is KE as per Sharpe model, Sharpe single index model. Are you all understanding now? this is Ri bar is equal to alpha plus beta times the Rm bar. Okay, plus EI is there or not there? Not there. Are you all understanding? This is the equation. This is what I was trying to make you understand. Okay, are you all understanding? If I, clarify, if I, really want to, if you really want to have absolute understanding, I'll tell you, this is the this equation is there, na? This is regressed return. This is the regressed return which you require from the security. This is the actual return from the security. Are you all understanding now? Clarity is there, because actual return, if you there, EI will not be considered. Are you all understanding? The EI will be removed. Actually speaking, alpha plus beta times the Rm will be the actual return, or EI terms will be there. EI term will be there. Are you all listening? Which means EI will be there while computing the actual return, because there will be error, na? So you have to consider that. Listening? Now, this we did, na? Next what we understood is that how to find the risk of the security. This is return of the security. This is actual return of the security. This is expected return or required return of the security. Now, risk of the security, yes, risk of the security. In terms of variance we measured. How we got risk of the security? Very simple. Risk of the security is what? Please tell me. Beta square of the individual security. BI, individual security is beta. Reliance Limited or Tata Limited, whatever is company. Beta square sigma m square plus sigma EI square. Are you all understanding? This is systematic portion. This is unsystematic portion. Apart from that, coefficient of determination also we learned, which is nothing but systematic risk divided by total risk, which is systematic risk by total risk. This is what we learned till now. Shall I proceed? Shall I move on to the next area? Okay. Now what we are understanding is, how to find out portfolio risk. Now we understood individual securities return and risk, na? Now portfolio return and risk we need to find out, na? Yes, portfolio return and risk we need to find out. Portfolio return, again nothing but weighted average return of the individual securities inside the portfolio. Nothing to be discussed as such. Are you all understanding? Now, what is the portfolio risk? Here important observation. Portfolio risk as per Sharpe single index model is very, very simplified. This is also weighted average risk of the individual securities inside the portfolio, by considering beta as a measure of risk. That's all. Are you all understanding? So put it simply, I'll tell you. This is in terms of individual security. Individual security, correct? Now portfolio risk, portfolio return you already know. Portfolio risk I'll summarize. Portfolio risk. What is the portfolio risk? Very simple. Beta, what is the individual securities risk we learned? Beta square sigma m square, agreed, plus sigma EI square. This is what we learned there, na? Here, what we are understanding the same thing in a different manner. Beta square of the individual securities were there, na? Instead of that, you will consider beta of the portfolio. So beta of the portfolio square, sigma m square, this will remain same. Are you all understanding the first term? Systematic variance, you are understanding the systematic variance. Now come to unsystematic. The sigma EI square is there, na? Now this needs to be segregated, because there will be, if assume there is a two security portfolio. There is a two security portfolio. What you should do, I have put it here. Are you all understanding? Two security portfolio, assume there is security X and security Y. There is two security in the portfolio, security X and Y. Here, you have weight, you need to consider the weight of the security. Weight of the X square into, sigma EX, this is sigma EX square, plus, weight of Y square, see here, weight of X square into sigma EX square, plus weight of Y square, sigma EY square, weight of Y square into sigma EY square. Listening? This is nothing but elaboration of the sigma EA square. Error term of the portfolio is nothing but weighted average error of the individual securities inside the portfolio. That's it. But here, here also if you notice this, beta square sigma m square, this can also be elaborated like, now same way you need to compute portfolio beta, correct? How will you compute this? This also can be elaborated. Beta of the portfolio is what? See, weight of X, beta of X plus weight of Y, beta of Y, the whole square. This is nothing but beta of the portfolio square into sigma m square will give you this systematic variance. Are you all understanding? This is what I have elaborated here. If you notice, okay, these two things are same. Okay, variance of the portfolio is simply beta portfolio square sigma m square plus sigma EI square. But if you elaborate, you can get this like this. Are you listening? Okay, shall I proceed? Okay, see. Now we will solve few questions in this regard and we will move on to the next model APT. Okay, first listen. Question number 40 we will take. Okay, now Sharpe single index model, segregation of systematic and unsystematic. See, in the question number 39 earlier, I think we have solved all the part there. See, I'll just show. Yes. See. Okay. See. Also find the CML for this and analyze the security variance into systematic and unsystematic. See, first beta value we computed 0.15. Regress method, yes, you used regression method and computed. Then also find the CML for this and analyze the security variance into systematic and unsystematic. CML here means not capital market line, it's characteristic market line which we use for Sharpe single index model. It's something different. CML2, assume it is a CML2. Okay, capital market line there we studied, this is characteristic market line. Okay, for this analyze the security. Also find coefficient of determination. That also we found out 8% was the coefficient of determination, balance 92%. Okay, this we segregated. So we solved this question. Okay, we will move on to the next question. Take question number 40. I want to quickly discuss two more questions in this regard and you will have absolute clarity. See. Take question number 40. Okay, the following details are given for X and Y companies. Okay, stocks and BSE Sensex for a period of 1 year. Stock return risk is given and Sensex return and risk will be given. Calculate the systematic and unsystematic risk for the company's stock, which means first step, what they are asking, systematic risk, unsystematic risk. Find out the total risk, segregate systematic risk, unsystematic risk of the security. If equal amount of money is allocated for the stocks, what would be the portfolio risk? Next question, first they have asked systematic, unsystematic segregation of the individual security. Then they have asked, okay, what is the portfolio risk if equal amount? Now weight is 0.5 and 0.5 for X, 0.5 for Y. Equal weight portfolio if you construct using security X and Y, what will be the portfolio system risk? This is what they have given. And coefficient of determination also given, which means they have already given that systematic risk to total risk is 18%. Where this will be useful, I will show. Okay, now first step, what is that? Systematic risk. Company X I will consider first. I will consider company X. For that, okay, systematic risk, beta of beta X stock beta is given, yes, 0.71. So beta of the X 0.71 square, okay, into variance of the market index is what you need to find out. Sigma m square is given or not given? Given. Sigma m square, how you find out? Sensex data is given. From Sensex, variance of the return is given. What is the variance of Sensex? 2.25. Directly you can take, so 0.71 square into 2.25, you will get 1.134 as systematic risk. This is systematic risk. Now unsystematic risk is nothing but total risk minus systematic risk. Either this way you can do, or one more method. See, very simple. What is the total risk? They have given the total risk as how much? Very simple. What is the total risk of the security? 6.3. Where they have given variance, they have given total risk. Here they have given variance of X as well as Y, which means there is a total return, out of which systematic risk comes to how much? 1.134. Okay, you reduce the systematic risk. Out of 6.3, you reduce the 1.134, balance 5.166, you will get it as unsystematic risk. Either you can follow this, or another simple method is very simple. They have given coefficient of determination, which means, okay, see, determinable risk is 18%, undeterminable risk is how much, unsystematic risk is how much, systematic risk we found out as 1.134, no issue. Okay, now undeterminable risk is what, 82% na. So how much is that? 6.3 into 82%, 5.166. Are you all listening? This is what they have done. 6.3 into 0.8 to 82%, 5.166. Are you all understanding? Next, total return, risk, systematic plus unsystematic, 6.3. They have asked. Okay, next come to company Y. Same drill. Systematic risk, how to find out? Beta y square into sigma m square. Okay, you will get 1.056. Total risk minus systematic risk, you will get unsystematic risk, or okay, 82% of the 82% of the total risk of this security Y, you will get unsystematic risk of 4.08. Now come to portfolio risk. See the formula and all you forget. You can simply write what I told you. Okay, you can simply simplify this formula. You don't need all these things. Okay, you just simplify the formula. Beta of the portfolio square into sigma m square plus EI portfolio square. This you just need to elaborate and show. This you can write it simply at the first step. Second step, you just show the computation. Beta of the portfolio in sigma m square. Now beta of the portfolio you need to elaborate. How is that? Very simple. Weight of x, beta of x into weight of y plus weight of y into beta of y, the whole square. Okay, you will get the beta of the portfolio square into 2.25. You will get the first term. This is systematic risk. If you solve this, you will get the systematic risk, portfolio systematic risk. How much is that? 1.0946. Now come to the unsystematic portion. Very simple. Weight x square into error of the x, error of the unsystematic risk of the x, plus weight of y square into variance of the error of security y. Are you all understanding what I am trying to say? Here, sorry, some student may ask, okay, here 0.5 square is there, here 5.166 square is not done. Don't ask these foolish questions, because 5.16 is already variance. This is sigma EI square. Are you all listening? This you don't need to again square it up. Listening? So this is square term. Okay, simply you add it, you will get 3.56786 as portfolio risk. And of course, out of this, if someone asks how much is systematic and unsystematic, you can show this. This is systematic, this is unsystematic. Next, take question number 42. Very, very important question. Okay, all the questions given in this module is very important, I feel, because it's a conceptual question. Okay, if you have thorough grip over these questions, other questions you can simply easily understand and go through. Say, a study by a mutual fund has revealed the following data in respect of three securities. Security A, B and C. Standard deviation given. Correlation with index is given. Are you understanding? This is correlation of security and market. This is given, which means for security A and market, this is the correlation. Security B and market, this is the correlation. Security C and market, this is the correlation. Understanding important, because they will ask something different. I'll tell you what is the catch in this question. You will understand. So the standard deviation of the market portfolio BSE Sensex is 15%. Sigma standard deviation, again, this is not variance, this standard deviation. So sigma m is only given as 15%. Are you all understanding? Not sigma m square. Okay. Now, there in the previous question they had given variance of the market. These are all the important things you need to notice. 2.25 is variance of the Sensex. Okay, not standard deviation. Here the standard deviation 15%. Right. What is the sensitivity of returns of each stock with respect to the market? First part we will try to understand. Sensitivity of the stock to the market is called as what? It is nothing but beta. Sensitivity of the stock to the market is called as beta. I already discussed this, which means, see here, so sensitivity of the each stock to the market, okay, standard deviation of this much, variance of the market is this much. Okay, here they have used this formula, which means sigma, okay, ABC na sigma A by sigma M into correlation of A and M, and sigma, okay, B by sigma M correlation into correlation of B and M. Like this, we need to find out what is the beta for these three securities. This is what they have done here. Okay, 20 by 15 into 0.6, you get 0.8, 1.14, 0.6. Are you all understanding? First part, beta computation over. Next, what are the covariances among the various stocks? What are the covariances among the various stocks? Which means, very simple. Now, there is a catch here. The question doesn't ask you covariation between this, covariation between the security and market. But the question is asking the covariation between, okay, these securities itself, which means covariation between, okay, covariance of A and B, covariance of B and C, covariance of A and C they are asking. These three covariances they are asking, and not covariances of security. Are you all understanding what I am trying to say? Okay, very important observation. Okay, here where beta is given for 3 stocks and the variance of market is also given, there you should use this formula to find out. I am not dwelling into the how to derive this. This is actually, okay, you derive from the the beta formula only. Listening? So very simple. We already discussed few things. Correct? We discussed how we got covariance. First tell me, when you found out correlation is nothing but covariance between security, correct, security, say A and B. Now correlation between A and B is nothing but covariance between A and B divided by what? Okay, sigma A, sigma B. Are you all understanding? This where we discussed in the first lecture, revision lectures, first part we discussed this. Remember, this is very important. Now the question is asking covariance between A and B, correct? I have sigma A, sigma B, fine. But okay, here if you notice, we have beta, okay, yes, we have correlation given, security and market correlation is given. If you see, sir, very simple, if they are asking covariance by giving correlation data is there, they are asking us to find covariance, fine. But the problem here is, okay, correlation of securities they have given a correlation between security and market. They have given a correlation between security and market, respective correlation between the security and market is given. But you have been asked to find out covariance of securities, covariance among securities. Are you all understanding the catch? Okay, so you cannot simply apply this formula, which means covariance of A and M. Okay, for finding correlation, for finding covariance, see, very simple. I'll tell you what is happening. I'll just write it in separate sheet here. That is why I don't want to confuse you. Listen carefully. What happens here? We already discussed a correlation between A and B. What is the formula? Covariance of A and B divided by sigma A into sigma B. Agreed? Now, covariance of A and B, same thing. I just rewrite, cross multiply correlation of A and B into sigma A into sigma B. This also you agree? Shall I proceed? Same thing, correct? But the problem is, in this question, sigma A, sigma B, all this you can find out, no issue. Correlation between A and B they have asked. They have asked covariance between A and B. Covariance between A and B, this is what we need to answer. Fine. But in the question they have not given correlation between A and B, they have been given, okay, correlation between A and market, correlation between B and market, correlation between C and market. Are you all understanding? But never they have given correlation between A and B, hence there is a catch. Are you all understanding? This is why, okay, we have a separate formula for this, where covariance between two stocks, how to find out? Using beta. Now, without introducing beta, okay, this is how we need to we found out now correlation between A and B into sigma B. Using beta, the formula, okay, will be changing like this: beta 1, beta 2 into sigma square m, which is variance of market. Very simple. Covariance of A and B, where correlation of A and market is given, there what you should do, very simple. Correlation of A and market is given, using that you will find out beta, na? So you have beta 1, okay, into, see, beta 1 into beta 2 into beta 2 means beta A, here I just put it, see, very simple, covariance of A and B. So what do you do? Beta A into beta B. If it is covariance of B and C, beta C into beta B into beta C. Like this you need to understand. Okay, beta of A into beta of B into, okay, what will happen here? Variance sigma m square, variance of the market. If you multiply, you will get covariance. Are you all understanding what I am trying to say? Okay, how this is derived and all, I am not going to take your time and discuss here. Okay, this is not necessary. You just remember this formula. Okay, beta A into beta B into sigma m square. If you do, you will get the covariance. That is what they have found out. Okay, see here, they have put a covariance matrix and they have found out. You can apply the formula and will directly get it. Okay, how you see, very simple. You will get this. This is covariance matrix. Are you all listening? Stock is there. A, B, C, beta. This is beta of A, beta of B, beta of C. 0.8, 1.14, 0.6. Just now we computed in the step number 1. Next, in the vertical column, if you notice, this is given A 0.8, 1.14, 0.6. Now, what is this 400? This is variance. See, very simple. This is A, this is A. Upper this is sigma A square, this is variance, sigma A square. Nothing but variance of A is 400, which means variance of A is what? Yeah, sigma A is how much? 20, na? Just now, the question itself gives you sigma A is how much? 20. Sigma B is how much? 18. Sigma C is how much? 12. Upper variance of A, 20 into 20, you tell me, this is a 3 security portfolio. First point, this is a 3 security portfolio. How many total terms will be there? 9 terms will be there. I told you, out of the 9 terms, okay, 3 variance terms will be there, 6 covariance term will be there. Agreed, first point, where I discussed it. First lecture I discussed. This is why basic concepts is very important. If you have not gone through that lecture, please go and listen and make your basic strong. Now see, 9 terms will be there, okay, while computing the portfolio risk of 3 security portfolio. Now out of this 3 variance terms will be there. What are the 3 variance terms? What do you mean by variance? Sigma square. So sigma A square, 20 square, 400, 18 square, tell me 18 into is equal to how much? 324. 12 square, 144. This is what can you see the variance term? 400, A into A matrix, correct? Now B is there, B into B, if you do B into B, the middle term 324, 18 into 18. Are you understanding? Next, C into C, if you do, you will get 144, okay, which is the variance term of security C. You got 3 variance term, balance 6 boxes are there, na? This one, 2, 3, 4, 5, 6, correct? Okay, these are 6 covariance term. This is called as 6 covariance term. Now how do you find out? Very simple. Just now I told you. Okay, now how to find out covariance of B and A? How to find out covariance of B and A? How will you find out? Very simple. What they have told. Okay, beta 1 into beta 2 into sigma square m. Here market index, what is the 10%, 15% or 15%? Very simple. So beta 1 into beta 2. Here 1.14 into 1.14. The matrix now 1.14. Here 0.8 into 0.8. How much is that? 0.912 into sigma m square 0.15 into 0.15. How much is that? Okay, 205.2. This is a total basis. They have computed why this is 205.2. Don't get confused. So okay, they have not taken decimal terms. 20 as such, they have 20 into 20. They have taken as 400 to simplify. Are you all understanding? You need to understand that 20 is a percentage term. Suppose this is 0.2 into 0.2. Really speaking, 0.2 into 0.2. This is nothing but 0.04. 0.04. The total terms they have computed as 400. Are you listening? So I will also show the computation based on that, but you can put it in decimal terms also perfectly right. No issues. Now 1.14 into 0.8 into this beta m square, if you do, you will get 2.5.2. 205.2 is what? Covariance term. Okay, to put it simply, this if you notice, what is the risk of the market? 15. 15 into 15, how much is that? 225. 15 into 15 is 225, yeah. Now, they have taken a total basis. I told you percentage terms, they are not 225 into 1.14 into 0.8. How much you are getting? 205.2. This only is there in this column. Okay, the 205.2. Here also the same 205.2. Are you all understanding? 2 covariance term will be there. A square plus B square, 2 into the covariance term, 2 into the respective covariance. So 6 will be there. 2 for each, 2 covariances for A and B, there will be 2 covariances. B and C, there will be 2 covariances. C and A, there will be 2 covariances. Total comes to 6 covariances terms. Are you listening? Next, you have C. Okay, in the C, this is 205.2 is covariance between B and A. Now, B and B is anyway variance term. C and A, we need to compute now 0.6, 0.8. 0.6 into 0.8. Okay, beta of A is 0.8. Okay, let me see. Beta of 8 is 0.8 into 0.6 into, okay, you have A and C. What is the sigma? Sigma m square. Okay, see, very simple. How to find out? 0.8 into 0.6, sorry, sigma m square. Okay, so 0.8 into 0.6 into 15 percentage, which is into 15 into 15. The sigma m square, now 108. Okay. This is 108. So how much is that? 108. Next, 153. How to find out? Very simple. 153, okay, is nothing but the covariance between B and C. 0.6 into 1.14. 0.6 into 1.14 into, okay, sigma m square. 15 into 15, how much is that? 153.9. Are you all understanding? This is 153.9. Okay, this is how you will find out the covariances between these two stocks. Okay, next. What would be the risk of the portfolio consisting of all the three stocks equally? Okay, if you consider the covariances of all the, what is the risk of the portfolio consisting all these three stocks equally means the weight of this security, okay, three security portfolio where weight is 0.5, okay, you have to use the big formula which Markowitz portfolio theory we learned, that formula you will use, okay, and find out variance of the portfolio is 400 into 1 by 3 plus 300 plus 1 by 3, 144 1 by 3 is nothing but equal weighted, so there this is variance term, 3 variance term and 6 covariance term, 2 plus 2 plus 2, the total comes to 200.244. Okay, next step, beta of equally weighted portfolio. Beta of equally weighted portfolio means, okay, where the you have to find out portfolio beta where the weights are equal, which means 0.8 plus 1.14 plus 0.6 divided by 3. Why? Because equally weighted, directly simple average will be weighted average, equal weight, so it will be equal to this 0.8467. Are you listening? This is portfolio beta. Next, segregation of risk into systematic and unsystematic. This also very simple. Portfolio beta, in the previous step we found out portfolio beta is 0.8467. Portfolio beta square, simply portfolio beta square is there into sigma m square. You will get the systematic risk 161.302. Out of the total risk 200.244. Systematic risk is this much. Balance 38.942 comes to unsystematic risk. Very, very simple and straightforward. With this we are through with the Sharpe single index model. Shall we proceed to the arbitrage pricing theory? Okay. Now let us discuss arbitrage pricing theory. See, very simple. Risk of a security is nothing but variability in the security's return. Are you all agreeing? Okay, see, if security's return is certain every year, it will be a risk-free security. There is no variation, there is no deviation from the mean. Agreed? So, risk arises from the uncertainty. Risk of the security is nothing but variability of the return of that security. Now, the return may vary due to two reasons: systematic factor, unsystematic factor. These are all the things we saw. How to measure the systematic risk? We saw that it is measured through beta and market portfolio variance. Here beta, beta square into sigma m square. Like this we measured systematic risk, correct? It is measured through beta as well as market portfolio variance. Like this we measured systematic risk. The unsystematic risk is of course unspecified risk, which is company specific. It is not due to market reasons, correct? This is what we learned. Now, an important observation is this systematic risk actually arises from the macroeconomic factors which we measured through beta in the previous models, like beta Sharpe single index model and the CAPM capital asset pricing model. Through this model we try to measure the risk using beta. Understanding? This is important observation because in arbitrage pricing theory this will be questioned. See what happens. CAPM states that unsystematic risk can be diversified away, hence an investor should require premium for the systematic risk only. Agreed? Yes, already we discussed. Now, both CAPM as well as Sharpe model uses market index as proxy for measuring systematic risk. This is very, very important. CAPM model and Sharpe single index model, two of the main market based model, what they did used market index as proxy for measuring systematic risk. Agreed? Wherever you see the formula systematic risk, they measured using market. Very simple. What is the beta formula we studied? Beta formula is sigma, security of risk of the security divided by sigma m into correlation of S and M. Here also if you see, there is market risk is there. Are you all understanding? Market index, will be taken as proxy for measuring this systematic risk. Agreed? And see, to put it simply, if you take beta of security is 2 times. Beta of security 2 times. Now what does it mean? The security return is changed by 2% when market return is changed by 1%. Correct? Apo, very simple. If you see that the market return, I'll just show you with the help of a graph so that you can better understand. Very simple. We have this, forget about this line, see, okay, see, we have this, and now if you see this x-axis, this is y-axis, this x-axis, okay, is a market return. Market return, I already told you, this is securities return. Now, the change in security return with respect to change in market return is captured through beta. This is nothing but beta, agreed? Which means the security return changes by market return is what we understood till now. That's why we took beta as a measure of risk, okay, and market index became the proxy for the macroeconomic factor. Are you all understanding what I am trying to say? But what APT says here, important observation is, APT says that market index cannot be solely treated as the, the factor, solely treated as the influencer. Why? Because really speaking, the influencing factor is not market index, the Sensex or Nifty, it is really the macro factors, macroeconomic factors, which means, I'll give you an example. In 2020, okay, COVID came. Suddenly, COVID came. Initially in February, okay, if you see China, initially it came in China. Thereafter, slowly it spread. And when it came to India, near India, they put the lockdown. Are you all understanding? As soon as the government announced lockdown, okay, the Sensex, Nifty, my entire stock market fell like anything. Are you all understanding? Okay, what is the important observation? The security, which means the security Reliance, Tata, all these companies also fell down. But the fall in the security, yes, the security shares inside the Nifty, it fell down. Due to Nifty's fall, really, or due to COVID? Because due to COVID, are you listening what I am trying to say? Same way, if RBI announces some interest rate changes, okay, assume the interest rate has been hiked or interest rate has been reduced. In that case, the Nifty will get impacted. Due to that, okay, ultimately the stocks will get affected. But real market mover, okay, market is getting, affected due to what? Due to macroeconomic factors. And see, very simple. Ultimately, macroeconomic factor is what I will put it like this. Okay, the security return varies not due to the index variation, but due to the factor which leads to the variation in index. Are you all understanding? Okay. Now you can read, you will understand. See here. Okay. APT says that the real source of systematic risk is not the change in market index, in fact is what made the market index change. This is very, very important. Okay, because while computing beta under CAPM and Sharpe single index model and all, what you did, beta is equal to change in security return divided by change in market return. So change in market return, you took that as market index as proxy, which you should never take, okay, which you should never take. You should consider the macroeconomic factor in the denominator, which means beta, okay, will be change in security return divided by change in GDP, or I say inflation, or various other economic factor due to COVID or geopolitical issue, Russia-Ukraine war. Like this you can keep on saying. Are you all understanding the issue? Now comes the important observation. Sir, beta, if you consider just the index, it will be 1 beta, which means if beta comes to 2 times, okay. Sir, what is the problem of keeping market index, taking market index as the proxy? The problem is, if you take market index as proxy, assume you calculated beta as 2 times, okay, since market is representative of all the other macroeconomic factors, what will happen really now? Which means you are trying to communicate, which means you are trying to take 1 beta for all these different macroeconomic factors which will affect each and every company in a different manner. Are you all understanding? That's what I have given in notes. If you see, in fact, it is what made the market macroeconomic factors. Okay. Some examples of risk due to macroeconomic factors: business cycle risk measured through GDP change, interest rate risk, inflation risk, energy risk, foreign exchange risk. All these are different macroeconomic factors. See, this is the important observation. When we say beta of security to market index is 2 times, we presume that the security return is beta of 2 times for all the macroeconomic factors. If you just consider 1 beta, okay, just you calculated using market index. Market index is the only variable which is affecting the security return you are assuming, correct? Which means beta of 2 times means the impact on the securities return from the macroeconomic factors, okay, will be one and the same, will be same. That is what is the underlying assumption you are trying to communicate, correct? Which is incorrect. What they are trying to do is that this is not fair, because the change in GDP, the securities return will be varying due to GDP change or inflation or interest rate changes, but not in the same manner. Okay, I will give you a classic example. Let's take two companies in two scenario. We have two macroeconomic factors, GDP here, okay, and we have interest rate changes, okay, change in interest rate, like this GDP and interest rate, two different macroeconomic factors. Are you all understanding? Now, will these two macroeconomic, if we are saying the beta is 2 times, okay, if we consider only market as the proxy, market index as proxy, what we are assuming? We are assuming that all these companies, all these securities will get affected, okay, by different macroeconomic factors in the same manner. And that is what the underlying assumption now, because you have taken proxy, market index as proxy, right? That is wrong. Why? Because you see what happens, I take two companies, one is airlines company and there is utility power based company, okay, utility based company. Now what happens with regards to airlines company, you see this airlines company is heavily dependent on the GDP performance. If the GDP data is not correct, okay, not correct in the sense, if the GDP data, suppose for the past 2 quarters is a negative GDP or there is a decline in GDP, okay, we are moving into recession. Assume the economy, the country is moving into recession. In that case, you tell me this airline company is there, okay, will its P&L get affected? Of course it will be affected. Why? Because, okay, frequently the travel, other luxurious, the hotels, the travel business, all will get affected due to GDP. Hence, the airline business will report a reduced earnings, and because of that, okay, the stock price of Indigo or other companies will fall. Are you all understanding how it is getting impacted? The airline business will get heavily impacted by GDP change, but it is not, okay, the impact will not be same with regards to the power based company, utility based company. For example, okay, there is consumption oriented company, Britannia, okay, Marico. Will you stop eating biscuit if the GDP changes? Now, it will never happen. Are you understanding? Fairly, it is a stable business. And if you see the power, will you stop consuming power? It is never possible. So what I am trying to say is, this power based company will have more stable cash flows, correct? But here the cash flow itself will not be stable, and hence GDP will affect even more than, okay, the interest rate changes. But this power based company, okay, since this is the cash flows, the value of the company will heavily depend on, okay, the interest rate, because where there is steady cash flows, okay, the value will be ascertained by discounted cash flow method. Present value of all the future cash flows, discounting rate, you need to take the long term interest rate for discounting, which means if interest rate increases, the pricing, the bond valuation itself I explained. Remember, if interest rate increases, the bond price will go down, or the value will go down, value of any asset will go down. If interest rate changes, interest rate increases, and if interest rate decreases, the value of the asset will go up. Are you all understanding? So the power based company is more vulnerable to interest rate changes, and the airline business is more vulnerable to GDP changes. What I'm saying is, okay, which means you have to have different beta for different macroeconomic factors. This is a conclusion which we can draw. Are you all understanding? In the earlier model, we had only one single beta, okay, and that beta, for calculating that beta, we took market index as proxy and calculated the beta. But here in APT, what he says, really Ross, okay, found out this, what he really came up, beautiful theory, okay. Anyways, he came up with this theory that each and every macroeconomic factor will not have the same kind of impact. Hence, we have to find out the factor beta separately. That's why this model is also called as factor beta model. Are you listening? Which means for every macroeconomic factors, we need to find out separately beta. Then we will find out beta into, see, in the CAPM what we did, K is equal to RF plus beta times the RM minus RF, where RM minus RF is market risk premium. Okay, and beta is representative. What here we are trying to do na, KE as per APT, arbitrage pricing theory, is nothing but this is lambda 0 or RF, this is lambda 0 plus beta into lambda 1. Okay, beta 1 lambda 1 plus beta 2 lambda 2 plus beta 3 lambda 3. Sir, what are all these lambda, okay, lambda 1, lambda 2, lambda 3 na? No issue. This is nothing but, okay, factor risk premium, which means this is, see, say this is inflation. So what is the risk premium for this factor? This is nothing but factor risk premium, factor risk premium. So this is lambda 1 means inflation premium. What is the premium you have to pay for the inflation into beta 1? Are you all understanding? So you will get beta 1 into inflation 1. You will get this specific premium, okay, which pertains to this particular factor, macroeconomic factor. Because this beta, this is very simple, beta of this factor, this beta 1 means beta of inflation, okay, into risk premium of inflation, risk premium of inflation. Are you all understanding what is happening? Next, this is, okay, assume this is interest rate changes, beta for the interest rate change into, okay, market risk premium, or you should not say market risk premium, okay, inflation risk premium, interest rate risk premium, currency risk premium. Like this you keep on adding the premium. All these are nothing but premium na, 1, 2, 3, these premium. Okay, what are all the factors available, these premiums you will put and add a risk free rate to that, you will get the KE ultimately. Are you all understanding? Okay, this is the only thing. Okay, this is a beautiful model, but practically, you know, everywhere CAPM is the used model and not arbitrage pricing. The reason being, okay, how to find this factor risk premium is a very tedious process. If you see in the question answer, they will give the data straight away, they will give what is the factor risk premium. That is not an issue. Solving the question is totally different from solving this issue in the real life. Are you listening? So this is the, okay, this theoretically fine, but practically it was never viable, and hence, okay, even CAPM got, okay, Nobel, and this theory is accepted by everyone. Yes, this is the issue, but anyway, this is very impracticable. So even today globally, CAPM is the accepted model everywhere. CAPM is very famous and accepted because of its simplicity. Because of its simplicity, beta you can easily find out, okay, RF you know, and so market RM minus RF, market risk premium also you can find out. Like this required rate of return, the process of finding required rate of return was simplified by CAPM, hence that is more, okay, relevant. Anyway, this is a very good theory. We have given notes here, we can go through. When we say beta of a security market 2 times, we presume that the security return has beta of 2 times for all the macroeconomic factors affecting a market index. This assumption is wrong because all the macroeconomic factors need not affect the company in the same way. Okay, for example, this is the utility based company and power based company I have given, and here in CAPM we required K is equal to required rate of return, arbitrage pricing theory, this lambda 0 is nothing but risk free rate, okay, beta 1 lambda 1, beta 2 lambda 2, like this it will move on. How many factors are given in the question? If 5 factors are given in the question, it will run up to, okay, lambda 5. Are you all listening? And etc. are factor risk premium, lambda 1, lambda 2, etc. are factor risk premium. Okay, how to find out factor risk premium? Tedious process in real life, mostly will be given in the question. There is process we will understand, okay, you know, in the regular lectures we used to discuss, no issue, no need for examination also, hence I am, okay, bypassing that. If not for simplicity, we can calculate as expected value minus actual value. This is important. Okay, for simplicity purpose, we can calculate the expected value minus actual value. Okay, this they have viewed, institute has used this in one of their question, hence I have put it here. Okay, for simplicity you can understand that expected value minus actual value, the difference between expected value, okay, in the inflation, assume the expected inflation is 8% and the actual inflation is 7.5%. This difference, okay, this difference is factor risk premium. This is what they have simplified and given. Okay, really speaking, it's a big process to find out. Okay, to find out one, factor risk premium, you need to make other, a factor risk premium to be 0, you need to assume it to be 0 and then solve as if all the other factors are irrelevant. Then you will get the okay, total premium, then you reduce the risk free rate from it, then you will get a specific premium for it. Okay, all these things I don't want to discuss here. Anyway, now one more important thing I wanted to discuss incidentally, concept of short selling, because in questions related to APT, arbitrage pricing theory, they have put some adjustments related to short selling. As such, this is not relevant under APT. This can be understood in a separate discussion also. Okay, a few lectures, if you see our regular lectures in one of the batches, we teach it separately. Okay, during the derivative segment itself, we explain the short selling. But in some of the lectures, I explain it here because arbitrage pricing theory has one or two questions. Okay, with regards to short selling, how to understand this adjustment we are trying to analyze. Okay, see, very simple. I'll explain you what is short selling, then I'll come back to the notes. Notes you can simply go through. Just understand the process simply. Okay, notes I've given a paragraph now, don't need to read all the thing. If you understood the concept, that's enough, and I'll give you summary of each and everything. See, very simple. What do you mean by short selling? I am an investor, say Mr. J. I am an investor. Now, I approach the broker. See, there are two possibilities. Okay, I either anticipate the rise in stock price or I can anticipate fall in stock price. Agreed? Now, I can expect increase in the share price or decrease in the share price. What I do is that, okay, I am expect decrease in the share price. Instead, if you are expecting increase, now what do? You buy, right? If you expect increase in share price tomorrow, today, assume this is today. Okay, this is after 3 months. After 3 months, right? If you anticipate increase in the share price after 3 months, today you will buy because later you can sell at a higher price, correct? You can book profit. But assume today, okay, you are thinking that after 3 months the share price will be lower than today's price. Today Reliance share price is 2000 and after 3 months you expect the share price of Reliance to become 1700. You are bearish on the stock, correct? You are bearish on the stock, you expect the prices to fall. What do? Can I sell today and can I buy tomorrow? Are you all understanding? Today you can buy and tomorrow you can sell and book profit if you are anticipating price increase. This I agree, fine. But if I am anticipating price decrease, sir, can I sell today and buy tomorrow? Is this possible? This is a very interesting thing. Can I do that? But the problem is, for me to sell the stock today, for me to sell the share today, I need to have the share in my hand today. Are you listening the problem? Understanding the problem? Okay. For something to sell today, see, very simple. I am telling that I am going to sell the house property tomorrow. Okay, the other party asks, where is the house now? I am saying that I am going to sell that house property of the third party. I am going to sell his house property. Is it possible? Transfer of the Property Act will not allow that to do. Are you understanding? You have to have the ownership. Here only the short selling comes into picture in the market. Okay, this is possible. Okay, it depends on country. Various countries have different policies for that. Okay, different markets have different policies for that. Okay, you can have the position open for say 1 month, okay, intraday basis or 1 week. It all depends on the exchanges. Okay, if you see in India, if you see for particular stock, mostly it should be closed in intraday. For short selling is not permitted in the cash segment. We call it as cash segment beyond intraday, which means if you want to sell on the same day and buy the same day, you do it, no issue. But you can't take the position or carry forward the position and keep the position open for a week or month or so. Are you listening? In the derivative market, obviously futures and options you can do it. Derivative market is open. Short selling you can easily do. Anyway, futures you are going to sell now, something similar to short selling, right? See. So here what happens? I can sell the share. Yes, I can sell the share and later I can buy. Sir, how the process happens? You need to understand. I am Mr. J. What I do? I want to sell. I give a sell order to the broker. I tell the broker, please sell me the share. Are you listening? Okay. In this case, what I do? The broker, what he does? There are two possibilities. Either he may have, the broker may have, okay, his own demat. He will have some shares. Are you understanding? He may have some shares which he may sell it. Okay, he himself may lend it. It is as good as broker lending to us. Are you listening what is happening? So broker, if he has the share on its own, say Reliance Limited, Tata Limited, all these are famous stock, broker will have, obviously you understand, broker will have their own bulk position open in the market. Are you listening? Each share, they will have their own stake, which means if someone comes to short selling, broker can either provide his own shares. That is fine. Sometimes what happens, there is a lender. L means represents lender. Okay, this assume broker doesn't have the share on its own, on its hand. Okay, now what happens? He goes to a lender, he borrows the shares. It is possible? Yes, it is possible. He asks for the share and tries to sell the share. Are you listening? There is a buyer. After selling, okay, the buyer will buy the share now. This is one. Are you listening what I am trying to say? So buyer will have the share. Lender is also owner of the share, but he lends to the broker. Broker sells the share for us. We sold it. Now, the real issue, this has happened today. On the date of maturity, when you are settling or when you are closing the short position, what will happen? Okay, you have to buy the share from the open market, whatever price it is. Now, sometimes you may get the profit, sometimes you may incur loss also, correct? So on the date of maturity, assume the share price is lesser. Okay, today you sold for 100, then on the date of maturity you bought it for 80 rupees. Are you understanding? This 80 rupees per share you bought it now. This share, what you do, okay, you will give back to the broker, which means it will be credited. You bought now, it will be credited now. So the broker will take your share and give it back to the lender. Are you all understanding? Give it back to the lender, which means the lender really not sold the shares, it just lent the share. Are you all understanding? Who will lend the shares? The investment banker at all, they will have bulk of these, okay, shares, underwritten shares or any other, okay, shares. They will have exposure to these markets now. They will have the shares. They may operate as lender for these transactions. Okay, so you understand it. So the broker will pay back the shares to the lenders. Are you all listening? This is how short selling happens. Okay, for you, the main thing is for you, okay, the position will be closed. Sometimes, okay, it might be squeezed also. The lender may immediately ask for the shares. In that case, you have to buy on the date itself, whatever price is prevailing in, okay, say if you have 1 month, you plan for 1 month, but after 10 days itself, if lender asks, now you have to anyway close the position and give. This position is called a short squeeze also. We will discuss it later. Anyway, these are all the things I have given in notes also. Now, very, very important observation. Okay, all these things are there. This is short squeeze, I told you. Okay, square of the position and how this happens, explained everything. I don't want to discuss again and again. I've given everything as notes, you can go through. You will easily understand the context. Now, what will happen? Okay, sometimes the company may declare dividend. In this case, you tell me, okay, the dividend is being declared. This dividend actually should be, since you are okay selling the shares initially at the come dividend price, you have to compensate. Okay, to the lender. The lender will be there. The lender, you have to pay the dividend. If at all the company pays dividend in between, that dividend you should compensate to the lender. Okay, anyway, these things are have been given in notes, no issue. Now come to the main discussion of this short selling. What short selling will create, you need to understand. This short selling will create a negative beta situation. This is a very, very unique concept in APT. Okay, I will not say this is APT related, but okay, it can be linked to any other concept. The main difference, okay, we need to understand between the short position and borrowing, which means you can borrow money. Short position is what? You borrow the shares. Are you all understanding? While taking short position, what you do? Borrowing shares. What you do in the sense, the broker has to do for you, right? Because ideally, you are selling a share of which you are not an owner. You are not at all an owner, So you are selling, you are borrowing the shares and selling. Which means, sir, borrowing the shares is better. Borrowing the cash, which is real borrowing money, is better. Question arises, Now we are going to clarify that. Okay, now the short position will even create negative beta situation. Are you all understanding? Very simple. How this will happen, I will show you through numbers. Then only you will have absolute clarity. Now it's very premature to discuss all these things. Through numbers, I can easily finish off the discussion. Shall we? Okay, take one question. I'll come back to the short selling, negative beta situation. We'll solve this question. Through this question, we'll understand how negative beta is created. Shall we? Okay. Portfolio factor beta. Anyway, assume that only two macroeconomic factors, factor 1 and factor 2, impact security returns. Investments A, B, C have the following sensitivities to these two factors. Investment beta 1, beta 2 given, which means 3 security given A, B, C, and there are 2 factors. For the 2 factors, we have been given 2 different beta values. we are given the expected risk premium is 4% on factor 1, 8% on factor 2. Very simple. Expected risk premium 4% of factor risk premium is nothing but lambda 1. Correct? We have lambda 1 is equal to 4%, lambda 2 as 8%, and what we should do with the formula for KE as per this arbitrage pricing theory is nothing but RF or lambda 0 plus beta 1 into lambda 1 plus beta 2 into lambda 2, because only two factors na. Anyway, now what we have been asked, we will see, then we will proceed. 8% according to the APT, what is the risk premium on each of the three stocks? First point, what is the risk premium for the stock? Now, factor risk premium into respective beta will give you risk premium. Agreed? And this is for risk premium for that particular factor. You add it, you will get risk premium. See, very simple. I'll just show you. Here we have RF plus beta into RM minus RF. Agreed? Now, for this stock, this is the risk premium. For the share in the KE, if you see, this is RF. Balance, whatever, suppose KE is 18%, RF is how much? 6%. 12% is the risk premium. The balance portion, 12% is risk premium. Beta into RM minus RF is 12%. Agreed? If suppose under APT, the same data is given 18% KE, RF is 6%, the 12% is there, na? This is a total, risk premium of the security. This 12% again has to be segregated, risk premium for factor 1 and premium for factor 2. Are you all understanding? Like this, we need to segregate this thing. Agreed? Now, what they are asking really, what is the risk premium of each of these two? They are asking us to find out factor risk premium 1 plus factor risk premium 2. Add it, you will get the solution. Very simple, I have put it. Risk premium for each stock, lambda is nothing but 1.75 into 4 plus 0.25 into 8. Weighted average, you will get 9% for A, 12% for security B, and 16% for security C. Are you all understanding? If you simply add RF to it, you will get the K plus RF like this. You will compute the K. K is not being asked, hence I am not discussing about it. Are you listening? Shall I proceed? Next step, factor portfolio beta. Factor portfolio beta, how will you find out? Very simple. Security A, B, C is there. Now, here only important observation. What he says, suppose we buy rupees 2 lakh of A and 50,000 of B. Now, how much you are buying security? 2 lakh worth of security A. How much you are buying B? 50,000. Total comes to how much? 2 lakh 50,000. But the problem is we are selling 1 lakh 50,000 of C. Sir, what is this? I don't understand the question itself. Very simple. You have 1 lakh in hand. First, what you do? You sold the security C. You sold, short sold, possible? Yes, possible. Just now we discussed na. Up a short sold 1 lakh of security, 1 lakh 50,000 of security C, which means you will get 1 lakh 50,000 from selling. Are you all understanding? By selling the share, you will realize the cash. While buying, the cash will be outflow. While selling, the cash, the inflow will be there. Are you listening? Which means 1 lakh you had in your hand, plus 1 lakh 50,000 additionally you sold the shares and realized. So total how much you have? 2 lakh 50,000. This 2 lakh 50,000 you invested 2 lakh in security A and 50,000 in security B. Are you all understanding the position now? Now that is what you have given. Value 2 lakh 50,000. This is positive since this is buying. Agreed? 2 lakh worth of shares you are getting. Now this is minus 1 lakh 50,000 which I am short selling. Are you all understanding what is happening? You will realize 1 lakh 50,000 cash, but the value really speaking is a position is short position. Now you sold, so minus 1 lakh 50,000. Are you all understanding the value of shares? Next, proportion. This is total comes to 1 lakh. The total comes to 1 lakh. I told you na that total is what you have capital in your hand. You had 1 lakh plus you sold 1 lakh 50,000. You raised 2 lakh 50,000 total. Out of it, 2 lakh invested in A, 50,000 invested in B. So proportion 2 lakh by 1 lakh 2, 50,000 by 1 lakh 0.5, minus 1 lakh 50 divided by 1 lakh minus 1.5, respective beta you got. Are you all understanding? Now if you multiply this, what 2 into 1.75, how much is the number? You tell me. See, 2 into 1.75, 3.5, 0.5 into minus 1, minus 0.5, minus 1.5 into 2, minus 3, total comes to 0. Total comes to 0. Are you all understanding what is happening? Now come to beta. This is for factor risk premium. First, for the first factor, risk premium comes to 0. Portfolio risk premium. This we are talking about, not individual security risk premium. Portfolio risk premium, where in the portfolio we have all the 3 securities in different proportion. That's what they are trying to ask in the second question. Are you all understanding? Now comes to beta 2, 0.25, 2 and 1. Okay. Weighted beta, which means weighted beta 2 is how much? Okay, see here, beta 2 is this much, weight is 2, upper 2 into 0.25, 0.5 into 2, 1, minus 1.5 into 1, minus 1.5, total again comes to 2, which means factor risk premium for the second factor is also 0. Are you all understanding? For both the factors, risk premium is 0. Hence, okay, the K in this question is nothing but risk-free rate of return, because there is no risk portfolio. This portfolio's risk is what? 0. Hence, risk premium will also be 0. Are you all understanding what I am trying to say? We have constructed a portfolio which is a risk-free portfolio. But how this is possible? How? Okay, actually, this has been done now. Because of the short selling. Are you all listening? See, if we had borrowed this 1,50,000, then we could have borrowed at what rate? Not risk-free, at not 0%. You could only borrow at risk-free rate. If you borrow this at risk-free rate, okay, the beta, okay, the proportion minus 1.5 into 2, it will be, okay, even if it will not be 0, the weight portfolio risk premium will never come to 0. Why? Because risk-free rate will be there now. Are you all understanding what I am trying to say? You cannot create a negative beta situation. Okay, beta of a risk-free rate is how much? Beta of a risk-free rate is 0. Are you all understanding what I am trying to say? The proportion into beta, the beta will be 0 for risk-free rate. If you borrow 1,50,000, ideally yes, you can also borrow 1,50,000 and 1 lakh you have in hand. You can borrow 1,50,000, 2,50,000 in hand. You can put 2,50,000 for A and B. Are you listening? And borrow risk-free rate of return, you can borrow from the bank. This is also possible instead of short selling C. Now I am explaining why short selling is superior to borrowing. Are you listening the context? Now, how borrowing will impact? Now, borrowing beta will be 0. Yes, the 0 into 1.5 will be 0. Which means the minus 3 you cannot bring down, it will be 0, and 3.5 minus 0.5, it is still 2.5, and the portfolio will still be risky and will never be risk free. Are you all understanding? Portfolio risk can even be brought to 0. Okay, I told you when the correlation is minus 1, exactly minus 1, you can also bring the portfolio risk to 0. Same situation by using short selling. Okay, you can create a negative beta situation where you can bring down the portfolio risk to 0. This will only happen due to short selling and not from the borrowing. Are you listening? Okay, now this is why you could also bring down this to 0. Are you listening? Everything. Now listen to me, friends. Now we will go through the notes. I'll come back to the conclusion later. See here. In problem 26, the factor 1 beta says 2 times. This means GDP increases by 1%, security return increases by 2%. Okay. Yes, for a person who invested in securities, he will be happy when GDP increases and vice versa. However, for the person who has short sold the shares, why this is creating negative beta, you need to understand, or how it is creating negative beta. Very simple. You have sold the share. See, very simple. If you had bought the shares, if GDP, one macroeconomic factor we will consider, assume GDP. If GDP increases, the share price also increases. Correct? But if you have taken the buy position, it will be favorable. But if you have sold the share, very simple, I'll show you. See, GDP increases. What is the impact? Share price increases. Correct? Now, the point is, this is good if you have buy position. If you have buy position, what happens? You have bought at 80 rupees. GDP increased. The share price also came to 100 rupees. It also increased to 100 rupees. Favorable? Yes, favorable. Fine. Are you listening? Positive beta. Fine. How the short selling creating negative beta? I am showing. Are you listening? Now I am selling. I am selling this security. Correct? At what price? 80 rupees. I am selling the share at 80. And I'm buying at 100. Am I incurring loss? Yes, but you need to understand, if GDP increases, share price increases, okay, but my profit is not increased, my loss is getting, loss is getting increased or profit is getting reduced. Are you understanding? Listening, are you listening? Which means the security return goes down, change in security return goes down when GDP increases. This creates an opposite reaction, which is, which I call it as negative beta situation. The beta becomes negative now, automatically change in security return with regards to change in GDP is positive or negative? Negative. It is going opposite direction. Negative beta you can create. This negative beta creation only can happen through short selling and not just by borrowing. Are you all understanding? This is what I have given in notes. Please simply go through. Okay, nothing else here. Borrowing money. See here, borrowing money to make investment increases risk due to financial leverage, which means I told you the risk, portfolio risk can be even reduced to zero if you short sell, but this portfolio risk cannot be reduced to zero where you borrow. I told you still 2.5 will be the risk left, because of the positive beta situation, right? This is what I wanted to discuss, hence I've discussed here. Please go through the notes, everything I've given. By using short selling, risk-free asset, security with negative factor beta and security with positive factor beta, we can construct a portfolio called a zero risk portfolios. In such portfolio, if such portfolio gives higher return than risk-free asset, this will become the efficient, this will replace the efficiency frontier. Just to give you an idea, we were thinking that combining risk-free asset with market securities gave the best result. No, if you combine short selling, it will be even more, very good, because you can bring the portfolio risk to zero. Whatever return you are giving, suppose this portfolio gives you 13% return and Government of India bonds gives you 6% return, this is also risk-free, this is also risk-free, this will become a superior risk-free instrument. Are you all understanding? This level of clarity you should have in arbitrage pricing theory. Of course, examination, all these will not get tested, but from the understanding of January 26 examination, if you question paper, if you see, there were few very unique adjustments, and I'm thinking if institute decide to put such level of questions, you need to have this level of clarity to tackle the paper. Are you listening? Anyways, I've given the solution for the same, you can go through. See, so what is the solution, sir? You have told all these things, the questions we did not solve now. What is the sensitivity of portfolio to each of these factors? Anyway, D 0 and 0, because sensitivity, this is nothing but weighted risk premium, which is weighted beta 1 into lambda 1, beta 2 into lambda 2. Anyways, the total comes to 0. What is the expected risk free? See, hence risk of the portfolio is 0. Risk premium should also be 0. Why? Because 0 risk portfolio. The solution is here. This is the solution for this question. Anything else? Nothing. See here, the risk premium for the portfolio should be 0 because the portfolio is risk free since beta is 0. Anyway, we have brought the beta to 0 now. Yes. Last question. Yes, one more question we have, or this is the last question? Yes, one more question, simple question I have given. Anyway, we will go through these two questions and close the session. So, Mr. X owns a portfolio with the following characteristics. Factor 1 sensitivity given, security for security A, B and risk-free security. Factor 1 sensitivity nothing but factor beta. Beta 1 given, factor 2 sensitivity, beta 2 given, 0.6, 1.2 for these two securities, and risk-free security anyway beta will be 0. Expected return 15%, 20% and risk-free rate of return 10% is given. This is expected return interchangeably used. I told you required rate of return will be used interchangeably as expected rate of return. It is assumed that the security returns are generated by two-factor model. Two-factor model APT should be applied. If Mr. X has rupees 1 lakh to invest and sells short rupees 50,000 of security B and purchases rupees 1,50,000 of security A, what is the sensitivity of Mr. X portfolio to the two factors? Very simple. See, how much Mr. X has? By default, he has in hand how much? 1 lakh to invest. What he does is that out of this 1 lakh, he short sells security B and realizes 50,000. So total 1 lakh plus 50,000, he will have how much? 1,50,000. That 1,50,000 he invests in security A. Very simple. If you want to find the proportion, he has 1 lakh in hand, he has, See, he has own funds 1 lakh plus short sold amount na, how much? Security B, he short sold to the extent of 50,000. Agree? So total how much he has? 1,50,000. This 1,50,000 he invested in security A. Are you all understanding? So he has only 1 lakh. How can he invest 1,50,000 in security A? You should not ask, because 50,000 he short sold and realized. Are you all understanding? So what is the weight proportion you need to find out na? So weight is 1.5. Okay, and for this is for security A. And for security B, what is the weight? Please tell me. Minus 0.5. Are you all understanding? He short sold na. The weight of security B is minus 0.5. Okay. What is the sensitivity of the Mr. X portfolio sensitivity? What they are asking? Portfolio sensitivity to factor 1 as well as factor 2. Let us see how they have computed. Very simple. Okay, portfolio factor sensitivity is equal to 1.5 into 0.8. 0.8 is what? Okay, see, 1.5 is weight of security A into factor 1 sensitivity of security A. So 1.5 into 0.8 plus, apart from that, weighted average, weighted now. So 0.5 minus 0.5 into 1.5. Very simple. I will show you here what happens. Security A and B. Are you listening? So here weight, if I say this is 1.5 is to minus 0.5. This is what we have invested now. See, very simple. Invested amount. How we got this weight? Very important. 1,50,000 I invest. I had 1 lakh in hand. I short sold 50,000. Okay, total I had in hand 1 lakh. Are you all understanding? This is the proportion. This is the weight. Okay, 1,50,000 divided by 1 lakh. How much is that? 1.5. That is what given. Minus 50,000 divided by 1 lakh minus 0.5. Are you all understanding the weight? Now this is weight na. So this we are computing for factor 1. This we are computing for factor 1. Portfolio beta for factor 1. Are you all understanding? The total comes to how much we need to see. Now factor 1 beta. Factor 1 beta, how much for security A and security B? Please tell me, children, what is security A and security B? 0.8 and 1.5. Correct? 0.8, 1.5. You tell me 1.5 into 0.8. Take out your calculator. 1.5 into 0.8. How much is that? 1.2. Okay, minus 0.5. This is one weighted beta. How much is that? 1.2. 1.5 into, what is the weight? Minus 0.5. 1.5 into minus 0.5. How much is that? 1. See what they have done. The security B, yes, minus 0.5 into 1.5, 0.45. Are you all getting this 0.45? Again, see, minus 0.8 into 1.5. Are you all getting 1.5 into 0.8? How much is that? 1.2. This one, okay, 1.5 into 0.5 minus 0.75. Please tell me 1.2 minus 0.75. 0.45. Are you all understanding? Now factor 2, for factor 2, same way, in a tabular manner I am presenting. Institute has presented straight away. This way you will not get confused. That's why I am presenting. Security A and B again. Weight, okay, same, 1.5 minus 0.5. Okay, straight away the value already given, we don't need. Factor 1 beta we will take. Factor 2 beta. Here factor 2 beta is to be considered. What is the factor 2 beta given in the question? Please see. Factor 2 sensitivity 0.6 and 1.2. 0.6 and 1.2. 0.6, 1.2. Please tell me weighted beta how much for factor 2? 1.5 into 0.6, 0.9. Okay, 1.2 into 0.5 minus 0.6 minus 0.6. How much is this number? 0.9 minus 0.6. How much is that? Okay, 1.2. Are you all getting the number? See, once again. Minus 0.5 into 1.2 minus 0.6. Right? 1.5 into 0.6. 1.5 into 0.6. 1.5 into 0.6. How much you are getting? 0.9. Okay, minus 0.5 into 1.2, 0.5 minus 0.5 into 1.2 minus 0.6 we are getting, okay, minus 0.5 into 1.2 and 1.5 into 0.6 is error. I think this should be 0.3. Are you all understanding? This is how you will get, okay. There is an error, I think. 1.5, see the calculation mistake, 1.5 into 0.6, how much we are getting? 0.9. This you put as memory plus, okay, minus 0.6 na, 0.9 minus 0.6, 0.3, okay, there is a mistake, no issue, 0.35 in a 0.3. Next, Mr. X current position, security, okay, what the second part of the question? First part stands answered. Second part, take second part of the question. If Mr. X borrows rupees 1 lakh at the risk-free rate and invests the amount he borrows along with the original amount of 1 lakh in security A and B in the same proportion as described in part 1, what is the sensitivity of the portfolio to the two factors? Very, very important. See what they say. The second part, they are asking us to mix it up with borrowing, which means they are saying you borrow 1 lakh rupees more, you had 1 lakh, you borrow 1 lakh rupees more, you will have 2 lakhs. This 2 lakh, what do you do? Okay, you invest the amount 1 lakh in security A and security B, okay, along with the original amount of 1 lakh in security A and security B in the same proportion. What is the earlier proportion we used? Plus 1.5 for security A, minus 0.5 for security B. Same way, short sold, okay, short sold 1 by 3, 3 is to 1 we use. 3 is for buying the security, minus 1, okay, 3 is to minus 1 is for selling the security. Here, what is happening, I will tell you. Original amount you had 1 lakh, plus you borrow 1 lakh more. This is the new adjustment, okay, new adjustment in part 2. Up a total 2 lakhs you will have as capital. What do you do? Okay, this 2 lakh rupees you invest in same proportion. Already what we did, okay, we did proportion 3 is to 1 or 3 is to minus 1 or 1.5 is to minus 0.5 was the proportion earlier. What is the minus represents, right? Just nothing but short selling. Okay, which means 2 lakh rupees you have in hand. Sir, 3 is to 1, into 1.5, now what should be done? Okay, very simple. Into 1.5, now what should be done? Tell me children. Now 2 lakh in your hand. 1.5, 2 into 1.5, how much is that? 3 lakhs. Sir, only 2 lakhs I have in hand. How can I invest 3 lakh in security A? Don't ask this question, you already know. What do? You short sell and realize the balance 1 lakh. Are you listening what I am trying to say? See, very simple. 2 lakh into 1.5. How much is that? 3 lakh. You borrow. You invest in 3 lakh security A. 2 lakh you have in hand into minus 0.5 is equal to minus 1.5 lakhs. Okay, minus 1 lakh. Okay, this, what do you mean by this? This is short selling. What do you do? Okay, you have 1 lakh in hand, you borrow 1 lakh, then you short sold security B to the extent of 1 lakh. Totally you will have 3 lakhs. This 3 lakhs invest in security A. Are you listening? This is how you should do. If you invest this 3 lakh amount, okay, then what will be your position? That is what they are asking. What is the sensitivity of the portfolio of the two factors? Again, same factor sensitivity beta we need to compute for factor 1. Portfolio sensitivity for factor 1, factor 2. How to find it? Very simple. Okay, security A, this is the proportion 3 is to minus 1 or 3 is to minus 1 they have written, or you can also write or 1.5 is to minus 0.5, which is same, both are same. Okay, risk-free asset weight is minus 1. I already told you now, you borrow, hence, so there will be 3 different security. I have put it here, you can already see, I have put the notes here. Can you see this? Okay, see. This is what, yes, this is what. For factor 1, you see what happens. Security A, B. This time one more security is okay added in your portfolio, which is RF, risk-free security, which means 3 lakhs minus 1 lakh because you short sold, minus 1 lakh here RF because you borrowed. Are you all understanding? So wait for this 3 minus 1 minus 1 because 3 divided by 1 total will be 1. Own funds is 1 na, so total will be 1 na. 3 divided by 1 3 minus 1 divided by 1 minus 1. So this is what the weight and this is the beta 0.8, 1.5 and 0. Why 0? Risk-free asset beta will be 0. I told you na. This multiplied by minus 1. So weighted beta, how much is the weighted beta? Tell me children. 3 into 0.8 plus, see, weighted beta sensitivity 3 into 0.8, 3 into 0.8. How much is that? 2.4 minus 1 into minus 1 point minus 1.5. This is 0. 2 minus 1.5, 0.9. Are you all understanding? Same way for the second part, see here, security, portfolio 1 factor sensitivity, 3 into 0.8 plus minus 1 into 1.5 plus minus 1 into 0, anyway 0.9. Same way factor 2 sensitivity comes to 0.9. Okay, you can simply go through. Now the last part of the solution, what they are asking, what is the risk premium for factor 2? Like this they are asking. Now, what do you mean by risk premium? Very simple. The question, okay, I'll show you here. See, APT, what they are asking, KE as per APT, how to find KE as per APT? Very simple. KE is equal to lambda 0. This is nothing but risk-free rate of return plus beta 1 lambda 1 plus beta 2 lambda 2. Like this, it will. We have two security portfolio. This is the thing. Okay, this is how you need to find out KE na. Here, important observation. They are asking the risk premium na. They are asking the lambda 1 as well as lambda 2. This is the factor risk premium they are asking for security. For this security. Okay, see here what they are asking. What is the risk premium for factor 2 alone they are asking. Factor 1 risk premium they are not asking. Anyway, we will get both the factor risk premium. For factor risk, factor 2, what is the risk premium? Now, here, see here. What is that? Yes, lambda 1 and 2 is there. This they are asking. They are asking lambda 2. Are you all understanding? Now, how to find out lambda 1 and 2? Very simple. KE they have given, I told you, required rate of return only is given as expected rate of return. That you will equate and form a simultaneous equation. Very simple. Okay, this is KE for X, A, B. What are the two securities given? Security A and security B. Na? So KE of A is equal to, okay, RF is how much? You tell me, children, what is the RF? 10 na? 10% plus beta 1 lambda 1. You already know for security A what is the beta? Security A, what is the beta? Okay, 0.8 na? Yes, 0.8. See here, 0.8. Okay, for factor 1 you have to consider, see, very simple, 0.8 and okay, for factor 2.6. So 0.8 and okay, 0.6. Are you all understanding? This is for security A. So security A, factor 1 beta, factor 2 beta, both you will consider 0.8 into lambda 1, okay, 0.8 into lambda 1 plus 0.6 into lambda 2. Like this you will form equation. This is KEA. This KEA already given in the question as 15%. So equate it. 15 is equal to 10 plus 0.8 lambda 1 plus 0.6 lambda 2. This is how they have formed this equation. 50 is equal to 10 plus 0.8 lambda 1 plus 0.6 lambda 2. 20 is equal to 10 plus 1.5 lambda 1, 1.2 lambda 2. Like this, both the required rate of return, you already know this left hand side. Right hand side, risk-free rate also you know. You also already know factor 1 beta, factor 2 beta for both A and B. Only thing which is unknown is lambda 1 and lambda 2. If you form this equation, reduce 2 from 1, simultaneous equation, if you solve, you will get lambda 1 as 0 and okay, lambda 2 as how much? 8.33%. If you substitute this lambda 1 0 in one of the formula, anyway you will get lambda 2 as 8.33. Simple and straightforward. Are you all understanding this for factor 2? So very simple. The question they are asking, what is the risk premium for factor 2, which is 8.33% if you solve. What is the risk premium for factor 1? Tell me. That also we got, which is 0. Are you all listening? Okay, with this we are through with this question. One more question quickly we will do and we will close the portfolio management chapter. See, Mr. Tamarind intends to, okay, this is intends to, okay, invest in equity shares of a company, the value of which depends upon various parameters as mentioned below. Factor given, okay, various factors, macroeconomic factors, GDP, inflation, interest rate, stock market index, industrial production. 5 factors are given. Okay, 5 factor betas are also given. Expected value and actual value. I told you the risk premium when you compute factor risk premium. Okay, if factor risk premium is given in the question, well and good. If not, you should if expected value and actual value given, I told you the differential amount will become the factor risk premium. Remember, this you multiply with beta, you will get the effective rate. Are you listening? What you should do, see, for example, I'll just calculate for one, you will understand. See here, return of the stock under APT. See, very simple. Return of the stock is KE is equal to required rate of return is what? Lambda 0 plus this is RF. RF given in the question? Yes, given in the question. I'll come back to that. RF given as 9.25%. Okay. Now, plus beta 1 lambda 1. Like this, you need 5 beta 2 lambda 2 plus beta 3 lambda 3. Like this, beta 5 lambda 5. These are all the factor risk premium you need to adjust. Here beta given or yes given, lambda 1 given or not given, lambda 2 not given, beta given for all these factors, sensitivity given, lambda 1, 2, 3 and all is not given. How to find out? Very simple. The differential value between actual and expected will be lambda. I told you in discussion. Okay, so what is the difference? Expect first take GNP for discussion. 7.7 minus 7.70 into beta, you will get 0.0. Are you all understanding? Weighted beta. Okay. Next interest rate, 9 is the actual value, expected value is 7. Okay, differential amount is 1.2, beta is 1.3. Are you all understanding? The difference 1.63. Sir, how this difference becomes a premium? Don't ask, because the variability in return is what is measured as risk here. That is the important observation. Okay, ultimately, how these are all calculated, it's a deep discussion involved. I don't want to do it in the revision lectures in YouTube. I don't want to do that. Okay, just to understand that the return, there is expected value is mean return 7.75. Is the actual same as mean? Not same as mean, which means there is variability, there is risk involved. Okay, this risk should be compensated with adequate premium. Are you listening? What is the understanding? So this is why you compute the variability of each and every factor and assign premium for these factors and multiply it with beta. Okay, then you add risk-free rate, lambda 0 to it, everything will be solved. So beta, you have this beta multiplied by lambda 1, 0 was the lambda 1. The differential amount is the lambda. Lambda 2 is what? The risk premium. Second, for inflation, how much is the risk premium we should pay? 7, 5.5, 1.5. 1.5 into 1.75 is the beta, you will get 2.63. Are you listening? So this is 0, beta 1 lambda 1 0, beta 2 lambda 2 2.63, beta 3 lambda 3 1.63, 3.4 and 0.5. If I add all this along with the risk-free rate plus risk-free rate, the total comes to 8.16 of these 5 factors risk premium plus risk-free rate of interest of 9.25, total KE comes to 17.41. Are you all understanding APT fully? Okay, with this we are through with this chapter, portfolio management. 2 topics which are not covered here, okay, which I will cover in mutual funds chapter. Intentionally I am leaving out because I don't want to, already 8 hours we discussed in the elaborate revision and we don't want to push everything here itself. Okay, those are common topics. Mutual funds is a light chapter and these topics are allied topics only, which are also used in mutual funds. Okay, some textbook they will give you in mutual funds chapter, some will be given in, some questions will be given in portfolio. So I am covering there. What are all the topics? Now, 2 important topics which I need to cover is that portfolio performance measure. Portfolio performance measure. Okay, this the Sharpe ratio, Trainer ratio, okay, Jensen's alpha, all these things are there. Then there is one more thing. What is that? Okay, you have okay, portfolio rebalancing strategy. Rebalancing strategy, the buy and hold strategy. Okay, and the what do you say, the rebalancing. Okay, equity and bond based rebalancing. I told you now, within debt and equity 50-50, how to rebalance it. Okay, that is there. One question will be there. And you have, okay, insurance based rebalancing. I told you now, floor, cap, all these questions will be there. So for portfolio rebalancing strategy, these 2 topics I will cover under mutual funds. Are you listening? Okay, apart from that, there is one topic called as a security lending scheme. Okay, you have the share lending scheme, stock lending scheme, which recently it was there in the syllabus only. Recently they have tested one question from past 3 or 4 attempts, within the past 3 or 4, not in the examination, tested in, I think in one of the MTPs they have given that question, which we have to solve. Anyway, I'll put up a separate video for that. Okay, and one more thing which I wanted to communicate is that this chapter, okay, yes, I have covered comprehensively all these topics, but only when you practice adequately the question answers, then you will get the absolute grip over the topic. Okay, otherwise just listening to these lectures and going for examination, it will not be comfortable, because there are many questions from this area which you need to, okay, get comfortable with. Okay, you only, if you solve, you will get comfortable. Otherwise, I cannot solve all these questions here anyway, but easily doable if you have the conceptual clarity. Right. With this, I'm closing the session. Okay. We'll see you soon in the next revision lecture, that is mutual funds. Thank you. And of course, please like and share our channel. Okay. If you like our content. Thank you.